Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 10% off, you can use code A1T10. Again, that will be a 10% discount off of any of their trials you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Hey guys, I just wanted to jump in for a second and let you know a little bit.
All right, good morning, everybody. Welcome back to another live stream. Let me center myself here a little bit. All right, so we have CPI day. Just want to make sure, can everybody hear me and see me okay? Just want to double check that my sound is good before I have made the mistake in the past of like going on a full rant and then not reading the chat and then realizing, oh, my microphone is muted. Audio is kind of weird. Oh, let me check.
Okay, try this. Is this better? Is this better? Check 1, 2, 3. Hopefully that is better. I think it was on my webcam mic. Loud and clear. Okay. All right. Good morning. Welcome back. Good afternoon, wherever you are in the world. Thank you for being here. Today's CPI day. It is a really, really important day in the markets. And we're going to talk all of it. We're going to take a look at metals here today. We're going to talk about what this inflation report means to markets. Real quick, what do you guys trade? Let me know in the chat. What is the one thing that if you couldn't trade anything else for the rest of your life, what are you trading? Is it the euro dollar? Is it the SP500? Is it gold? Is it NASDAQ? Is it Tesla? Everybody's got their thing. What's your thing? Let me know in the chat. If you could only trade one thing for the rest of time, what are you trading? If I was going to live for 1,000 years, I would trade only gold. You know why? Because I don't know what's going to happen to the world in 1,000 years, but I have a really good guess that gold will still be very valuable in 1,000 years. That's my guess. Still, the S&P 500, who knows? Maybe there's another stock market that takes its place, right? But if I could only trade for the rest of my life, probably the NASDAQ or the S&P 500. Coin flip, I would do either one. Okay, so what do you think of CPI? Yeah, let's talk about it. So we've got CPI coming out here in the next 10 minutes, and it's a really important figure for a number of reasons, but possibly the biggest one is that the market is on edge about inflation already because the tariff situation, what's happening with Mexico and Canada, what's the story there, right? What's happening with China? Market's already a little bit nervous, but perhaps not as nervous as it was recent, as much as like a couple weeks ago. Check this out. Take a look at the 10-year yield. It hit up to 4.8%, and what that's telling you is that the bond market was saying, we're not buying bonds unless you offer a higher yield, right? That's how you read this chart. This is an auction, right? Just like most markets. When this is rising, this is what bond buyers are willing to accept in the form of a yield on their bonds they lend to the U.S. government. When this is rising, people are saying, okay, you're going to need to pay us more in order to, in the form of interest, in order to buy your bonds, because we think inflation's going to be higher. We think the U.S. economy is going to be really strong, and that's going to lead to outsized inflation. Think about it. If I paid you 5% interest per year on something, but inflation that year was 3% or 5%. Let's say inflation was 5%. What is your real yield? After inflation, you made nothing, right? So bond investors, they think about this all day long. They say, look, where is US inflation going? If it's going to rise, you got to pay us more in the form of a percentage on our bonds. If you don't do that, we're not going to buy the bonds because we're just going to lose out to inflation. So when this thing is rising, people are clearly more fearful about usually inflation, or they think the U.S. economy is just really, really strong, and so there's some demand to get out into more risky assets. Why would I buy a bond when I could just passively, make better return in the stock market? So those are some things to think about. Okay, so with just 8 minutes to go here, what do we need to know about this inflation report? Well, it's going to move everything. It's going to move gold. It's going to move indices. It's going to move a little bit of everything. But what it's going to do the most is it's going to help or hurt inflation sensitive and by proxy interest rate sensitive parts of the market. Specifically, what typically moves a lot on CPI day is the Russell, gold, silver. The NASDAQ and S&P usually do as well, but it depends. Let's take a look at something together, guys. So we're looking at the CPI report. We have 6 minutes to go. And with 6 minutes to go, the CPI year over year number is expected to tick to 2.9%. Okay? That's a year over year inflation rate of 2.9%. If that number comes in higher, if it comes in at 3, if it comes in at 3.1, if it comes in at 3.2, how would the market respond to that? Well, the dollar would become very strong in that, right? Why would the dollar be very strong with a 3.1% return or year over year inflation? Well, because what people would see in that would be, oh, the Fed cannot cut rates. With inflation running strong like this, if you get a 3.1% year over year inflation rate, then the dollar is going to look very, very strong relative to its peers. The Bank of England is aggressively looking to cut rates. The ECB is looking to cut rates, right? They just did cut rates. The Bank of Canada cut rates. All these other central banks, except for Japan, by the way, they're all looking to cut interest rates. So if there's a really hot inflation print today, the Fed's going to say, we can't cut rates at this time. We're going to hold off on rate cuts. The dollar's going to look very strong. Take that with you and extrapolate that. I swear, my vocab is slowly getting better, guys. My English teacher will be proud. Extrapolate that, right? And think about it in all the other areas that you care about. If you think about a stronger dollar, how does that impact gold, right? It's not a positive thing. It doesn't necessarily mean it has to be a super negative thing. Well, it is a negative thing for gold. A strong dollar is a negative thing for gold, but people get confused when gold and the dollar move up or down at the same time. It's very normal to be confused by that. Why? Well, we talked about it yesterday, but oftentimes, the gold market does not trade solely on what the dollar's doing. It also trades on what other central banks are doing, cutting interest rates, and it also trades on geopolitical uncertainty, right? It has a little bit of a risk premium to it when people are fearful about, China and U.S. trade war concerns or what's happening in the Middle East or Ukraine and Russia, right? When you get these jolts to the system stories, gold typically behaves as a bit of a safe haven. So gold and the dollar do not have to move inverse to one another. They can move in the same direction. Although I would not call a very hot CPI print good for gold, right? There is something I need to discuss with you guys. And this is really important about the metals right now. It's why I really like the metals. And if we get a pullback, I'm very, very interested in them. Okay, so gold, huge move up higher, having a little bit of a pullback here. Let me show you something that's so important to gold right now. You ready? We have the possibility of dipping into this environment. I wish I could zoom in more for you on this, but let me just read it to you. An environment where you have low growth, and hot inflation. Now, we don't have low growth at this time, but we have less growth than we previously thought we did. Let me break that down very quickly with just a few minutes to go. GDP growth came in lower than expected. Services PMIs came in lower than expected. Retail sales numbers came in lower than expected. NFP came in lower than expected, but there were some revisions, so let's just ignore that one. And then JOLTS job openings came in lower than expected. So if you have a little bit of cooling growth in the picture here, right, take that as your first part. And then the second clause of stagflation is rising inflation. It is a possibility that gold could really psych people out today, where, okay, we've had a little cooling in the growth department data. What if inflation stays hot or gets hotter? It's kind of an interesting reaction, but I would actually say that if you get an initial, gut reaction, gold goes lower off of a stronger dollar, that actually could be a dip buying opportunity. In my personal opinion, I'm not here to give you financial advice, but this environment, stagflation, is an environment where I like gold, where you have inflation, commodities generally rising in price. Gold does, benefit from that, but growth being hurt is the key here. And I want you to understand that is so important to, typically inflation rising is not making gold going up. It doesn't make gold go up by itself, because if you have high growth with that, the Fed can hike interest rates and that kills the story for gold. But if you have a stagflation event, in which case inflation is rising, but the Fed can't combat that with hiking rates because growth, aka jobs, are not as strong, that's an environment where gold goes absolutely crazy, because they say, oh, the Fed's not going to hike rates on us and they've got inflation to deal with, and gold can go crazy, right? So it's something to think about. I wouldn't call us in this environment at this time, because our numbers here are not terrible. Like, we have a pretty solid economy overall. We're just seeing a little bit of light reads in terms of recent growth metrics. So it's something I want to just draw your attention to. We've got 1 minute to go here before the CPI report. That's something that I'm thinking about. I can't get into it much more than that with just a minute to go before CPI, but really important that we understand that concept together. This is why we focus on, what is my, this is interesting. They changed that. This is why we focus on the economic data. Understanding the environment you're in is so critical, and most traders never even understand that concept whatsoever. Make sure you understand the environment we're in. Guys, we got 30 seconds to go here. We've got everything pulled up on your screen. You've got S&P, NASDAQ, Dow Jones, Russell. Here's gold. Here's the dollar. Here's Bitcoin and oil. Everything's on your screen so that you can see the reaction across the board. Stay tuned. We're going to go ahead and roll our quick breaking news. All right, guys, we'll see what happens with CPI. Please be careful. Don't over leverage. Don't throw yourself into financial debt on a CPI report. You wouldn't be the first, and there are tons of people who do that, so please don't do it to yourself. Okay, CPI data should be coming out here in just a moment. You've got Russell lower here, Dow Jones lower. Looks like our NAS and S&P completely stalled out. Dollar is higher. Gold initially lower. That's going to suggest that the inflation number did come in hot. Oh, there's our S&P. Look at that. S&P and NAS down here initially. What are we looking at? Okay, we're looking at a pretty good sell-off in NAS and S&P, down just shy of 1%. We've got gold down 1%, silver's down 0.7. Let's take a look at that number. Okay, so we did in fact get that 3% number. 3%. So dollar just got very, very strong, guys, across the board there. Core CPI also ticked higher. Definitely not the inflation numbers that the doctor ordered. Pretty much hot across the board here. We have core CPI higher than expected. CPI month over month also higher than expected by a good bit. And CPI year over year, 3% compared to the forecasted 2.9. That is a hot CPI print. Let's take a look at what we've got in terms of a market reaction. Yeah, look at that. So S&P, NASDAQ down about 1%. Silver and gold down about the same. You've got the Russell, as I mentioned, that one's going to get hit the hardest usually in these environments. You've got Russell down 1.7%. Dow Jones down 0.8. Yeah, good bit of a sell-off there in terms of a market reaction. And let's see how this candle closes today. This will be really interesting just to see the reaction overall. You've got let's see, TLT. My TLT trade's definitely not loving this either. Down move here for TLT as well. Bond yields or 10-year bond yields, yeah, jumped up 1.76%. So big jump here for bond yields. Again, inflation stickiness is problematic for markets. You've got NASDAQ down 1% here today. And let's take a look at the daily chart. I mean, you guys know where I've been with this. The NASDAQ, the S&P 500, they've just been really tough for me because there's just nothing to do here. It's so choppy, so range bound. Would love to be a buyer if we had a bigger sell-off, if we continued lower. But with that inflation report, I wouldn't be surprised if we do see a little bit more of a slide here for some of the indices. Again, Dow Jones. But let's watch these metals, guys. I'm telling you what. Okay, none of this is financial advice. Don't do anything I'm saying ever. I'm not here to tell you. I'm not here to do your homework. But my opinion would be, I would be actually surprised if gold didn't have a bit of a snapback today off this. Because again, what do we just discuss? We just discussed that data here. Data here is suggesting a little bit of weakness in the economy. Sorry, guys, I just had to respond to an important text here. So the economy is showing some signs of disappointment, and yet when this updates, which this data will update momentarily, well, it takes a few minutes to load in the new data. When this data populates here, guys, we're going to see a 3% read, and we're going to see this showing red because the data is going to come in hot, right? So we are now actually officially seeing the U.S. economic heat map here is flipping decidedly red, which is very interesting. Now, when you have high inflation and low, guys, we're back in the threes, right? Here's the thing about inflation. This is the trouble here for the Fed. How can the Fed cut rates when we went down to 2.4%? When did we hit that number? October of last year. It's February, and we are now back to 3, right? So again, where does that leave us? That leaves us with a problem. That leaves us with the Fed saying, okay, so inflation is not done. This will be, guys, the 4th month in a row where inflation rose. So yeah, markets are not loving this. Let's go back to take a look at our charts here for a second. So you've got NASDAQ down about 1%, S&P down about 0.9, gold down about 1% off of this, Bitcoin down about 0.8, dollar index loving this, obviously. How's my dollar CAD trade? Dollar CAD trade's trying to come back from the dead. I've been in this. I'm long dollar CAD like right here, so I'm not in profit at all, but bouncing back a little bit. We'll see where that goes. Yen pairs. Let's see where we're at with those. So you had, where's dollar yen? I'm looking for dollar yen. Yeah, look at this, dollar yen snapping higher here with that higher than expected. Again, CPI print. I did take a short position on Swiss yen, so that hasn't really moved from where I took the trade. Dollar Swiss, look at this. Dollar Swiss looks great once more. This looks like it's trying to potentially break out. And again, I wouldn't be surprised if we do get some dollar bullishness here. I mean, we're looking at an environment where inflation is rising and other central banks are looking to cut rates. This seems very, in a way, dollar bullish. In a, you know, why do I say it's weird or confusing? Well, it's because we've seen some other data. We just discussed the macro environment that we're in, right? And again, I just want to reiterate, I said this earlier, and I will say it again. Most traders don't even know the macro environment that we're in. They don't even know what the macro is. They don't even know. So even if you are not a fundamental trader and you're watching this video right now, I would encourage you to know your basics. What environment are we currently in? Are we in a boom type environment, a Goldilocks type environment, stagflation or recession type environment. If you don't know those environments, if you've only ever traded in a Goldilocks environment, which I would argue has been, the better half of the last 5 years or so, where you've had lots of economic growth for the U.S., but inflation has been moderately kept at bay. We've had cooling inflation for the last 2 years, but that seems to be struggling now, right? If you don't know how to trade in an environment where we switch into stagflation, I'm going to tell you respectfully, you're in trouble. Okay, you're toast. If you don't know how to trade in a stagflation type environment, and you've built your entire trading career about trading in a Goldilocks environment, markets change environments, and if you're not ready for that change and watching for that change, you're going to be caught offsides, blindsided, taken out back, hit over the head with a hammer. Okay, that's what you need to understand. Is market environments are very important. Why do I say that? In certain environments, certain charts just trend one way. Or if it flips, they start going choppy. If a change in environment happens and you're used to trading gold on the long side for the last few years because it's only been going up, and it switches into a different environment, you can really seriously not see it coming. Your whole trading system can break down. Okay. So you have to understand which environment you're in and what the economic data is currently telling you about the environment that we're in. So just really wanted to make sure I pointed that out. Nick, those yen pairs pulled back rather fast. Yeah, Alan, we talked about those yesterday. I actually did end up, you might have seen it this morning, but I did take my initial position on the Swiss yen on the short side. We'll see how that plays out. I have willingness to add to my position at these levels. It's a bit more of a long-term short idea, but I officially am in that idea that we've been discussing for the last few, last few weeks, really. That's been something we've been waiting for. TLT, don't do it to me. Down 1.3%. Losing that momentum, that kind of stinks. I have a long position in TLT that is not working out very well. However, everything kind of took a big hit this morning. Here's the S&P 500 down 1% today. NASDAQ is down 1.2, kind of erasing once more those gains that we made here recently. And this is the thing, guys. Again, what do we just talk about? So I had somebody in my comment section the other day. They said, Nick, I was making really good money trading the NASDAQ, but now it's been horrible. And they said, how long do you think this is going to last? The commenter asked, how long do you think this choppiness is going to last for the NASDAQ? It sounded to me that they were like, I'm not making any money. I'm losing money, right? Trying to trade the NASDAQ, and it's just chopping back and forth. And they said, when is this going to end? And I responded to them. I said, I have no idea when this is going to end, right? Because here's the thing. I've already moved on to other things that I'm watching. Of course, I'm not saying like, oh yeah, no, I just always make money and I never take losses. I'm not saying that at all. But this is a market that I don't love trading right now. Like this choppiness. But why is that? It's because the market is trying to determine this. We may be in a shifting environment. We may not be in Goldilocks like we perhaps were for the last few months or last year or two, right? So if we're switching out of Goldilocks into stagflation, you don't want to be long stocks in stagflation. That's a painful environment to be long stocks, right? So I'm not saying necessarily that we've officially entered stagflation, but the market is chopping because it's trying to figure out, is that where we're going next? And some of the data would suggest maybe we're shifting a little bit, right? Early on, but we may be shifting. So again, that's the really important part of this. Guys, I've got two things for you. First of all, if you'd like to try out the Edge Finder, I've been showing it on the screen a bunch. This is our new market heat map. It helps us to understand the market data that's coming in and to better understand what type of environment that you're actually trading in. If that software would benefit you, if you would like to get on board with this concept of knowing your environment, what type of data are we working with? Are we working with a good environment? Are we working with a tough environment? If you'd like to get access to this, we'll drop a link here in the chat to try out the Edge Finder for 30 days. If you'd like to apply for that, click this link being dropped in the chat right now. So something to think about is, again, what environment are you in? And when this is all blue, right? Typically when this is all blue, that typically suggests kind of a Goldilocks scenario, cool inflation, etc. Also, Chandler James, if one of you guys could drop that link to the Edge Finder trial, that'd be awesome in case people would like to take advantage of that. So if I'm taking a look at the CPI report overall, like I said, it is higher than expected across the board, pretty hot inflation read. You got the Russell down 2% here today, right? So obviously not loving that. You send us a direct message here if you have questions, and I'm just going to, 1 second. Here it is. Okay, just dropped it. This is the link for Edge Finder trials. If that is something that you're interested in taking advantage of, you can apply for a trial using this link that's just been dropped in the chat. Okay, so let's see. Let's go take a look at those metals again. Again, keep an eye on this. Again, I could be completely wrong about this idea, but I would not be surprised if gold has a strong bounce back today. Because if we are shifting into a different type of environment, stagflation environment where inflation being high is kind of still okay for gold as long as the US economy is cooling. Like if we have a labor data problem, which I wouldn't say we do, but if that is the shifting environment, you know, JOLTS job openings were a little bit light. If you get that shift, you know, gold may sniff out, okay, this is actually weakness that we buy. So we'll see. I mean, I'd be a buyer of gold if we get a larger pullback. I've been talking about this here on the channel. You get me that 38.2 to 50% retracement. I like this area for a possible long side continuation. The second thing I have to announce, guys, is that we're doing a giveaway today for an Edge Finder copy. If you'd like a chance to win an Edge Finder copy, it is completely free to join the competition. And it's very simple instructions. Number one, join our Telegram channel. That is where we're going to be doing the free competition to win an Edge Finder. It's very easy to join. It's actually like very silly what we're doing. Click this link if you'd like to join our Telegram for a chance to win the Edge Finder. Take a second. It's free to join. There's like free courses in there and tons of free value. And take it all. I mean, take the free course, take the giveaways, all that stuff. But what we're going to do there is we are going to be dropping a link. And Chandler and James, if you guys could make sure we just double check that we drop that link again from yesterday. We're doing a submit your favorite trading meme competition. If you submit the meme that gets the most likes or responses, you're going to win a copy of the Edge Finder. Literally, join the Telegram, share a meme with us, and you might win an Edge Finder by the end of the day. So there you go. Yeah, but step number one, just join the Telegram. The instructions can be found in there right now. So there's your chance to win an Edge Finder literally by dropping a meme. Is that simple? Okay, so Russell down 1.8. You got Dow Jones down 1. NASDAQ down 1.15. Just continuing to chop around here. Look at this, guys. Silver is beast mode right now, only down 0.22%. Honestly, I saw that CPI report and I said, oh, my silver trade may hit stop loss. And we actually rebounded pretty well so far. I mean, that's too soon. The trade is still break even. But this is what I'm saying. Metals holding up here really well recently. I would not be surprised. I actually love, as a momentum trader, there's an indicator. There's a technical indicator that I love. I don't really have an indicator for this. I should. Actually, I really should. Like relative performance, okay? So look, we had bad inflation data or hot inflation data. Metals should fall. Stocks should fall. But what actually is the market telling you? The market's telling you, yes, stocks fell, but metals are holding up well. Does that make sense? Look at silver on a relative strength basis, on a relative performance basis. That's a really strong hold up, right? NASDAQ's down 1%, silver's down 0.16%. Same data, both negatively impacted the metals, and yet holding strong. So I actually really like that. Yes, it's down, but it's not down 1%. So that's a pretty impressive overall reaction from silver. So something to think about. Any updates that I make to the silver trade will be shared inside of our Discord group. If you're not inside of the VIP group and you would like to be, we'll drop a link to send a direct message to our support team about asking for a membership. If you'd like to sign up for the VIP room and get trade signals from myself and my team, you can do so by sending us a direct message on our website, a1trading.com, or using the link that's being dropped in the chat to speak directly to our support staff. What we're going to do now, guys, is we're going to transition. Up next, we got Tom from Simply Forex taking over the stream for a little bit to talk about some Forex trading setups that he is currently watching. So he will be up after this quick break. We're going to thank a sponsor and then set him up so that he's got his camera and screen all sorted out. And we'll be right back with Tom from Simply Forex just after this. If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on TradingView.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show.
Hello traders, how are we? Trader Tom here from Simply Forex, and I'm with you for the next 30 minutes. So let's just dive straight into some trades I'm looking at. But also, guys, please, if you've got any questions about any trades that you would like to look at from a technical point of view, then don't be shy. I will try and answer as many questions as I can. So obviously, US dollars super strong at the moment off the back of that inflation data. I also like Nick's silver trade. I'm going to take a look at that as well. But another couple of pairs I really like are a couple of Swiss franc pairs, right? If we start with the daily chart with these Swiss franc pairs, and hello everyone. Yeah, thank you for saying hello. We've got some really potentially nice areas of value to trade from. All right, now. You know, Aussie dollar Swiss franc was a little scruffy in terms of structure and trend, but we're clearly in an uptrend now, right? With Aussie dollar Swiss francs, we're getting higher highs and we stopped getting lower lows, right? We're in an uptrend. We've even broken this high and this important level of resistance, okay? So we like Aussie dollar Swiss franc buys. And just look at these candles, right? They are super bullish. Now, obviously, this daily candle is super bearish, but it hasn't finished forming yet. All right. So obviously, news has come out. It's sent some, pairs into, flying off. But, wait for the dust to settle. Let's see what this daily candle does by the end of today, right? It's looking bearish now, but you might end up with a candle that looks, something like this by the end of the day. All right, so don't jump into trades on the back of news. Now, if we look at the H4, I really need this level through here to hold, right? For me to consider Aussie dollar Swiss franc buys, because I like to be with day trend, and I also like the lower time frames to correspond with that daily direction. And this gray zone through here, this support and resistance zone, is a daily zone, but I could also put a small H4 level through here. And that's what I need to see not break. Now, we've got 10 minutes before this H4 candle finishes. And if this breaks this level, then I'm simply not interested in Aussie dollar Swiss franc sells, right? But if it holds on to these lows and holds on to H4 structure, and then we start seeing some bullish candles, I think we're at a really nice area for Aussie dollar Swiss franc buys, right? Potentially up to here, if not further. So Aussie dollar Swiss franc I like, and I also like Euro Swiss franc. Okay. Again, if we start with the day chart, right? We was in this uptrend, right? We had them huge gap downs last week, which just made, you know, technical trading a little bit harder, right? It brought another, you know, dynamic into the reading of the chart. But now we're in it's clear we're back in a daily uptrend, right? We're getting higher highs, these lows held. And again, look at the bullishness of that candle, right? It doesn't get much more bullish than that, guys, right? And we're entering some nice levels here, right? To potentially take price back up to these daily highs here and this big psychological 0.9500 level. All right, so that would be my target. If we drop down to H4, you can see from the H4 candles, you know, potentially this trade has a little bit more of a retrace in it, right? Does it want to retrace to this gray zone and we start seeing a bullish reaction? Or does it want to come even a little bit further? Perhaps moving average 20 catches up to this area and we start getting bullish candles in here. But as soon as we do, I am buying Euro Swiss franc, right? If we get some bullish candles in here or even in here, I will buy Euro Swiss franc. All right, so keep an eye out for this trade, guys. I think it has a good chance of success from a technical perspective. And Nick, I know Nick was in a silver trade. I like silver buys, right? I'm just waiting for a break of a certain level. Now, if we look at daily structure, right, we're in this uptrend, clearly in an uptrend. Okay, higher lows, right, higher highs. And then look how bullish that wick is from yesterday, right? Super bullish wick that held on to this level. All right, so I think we can take price back up to these highs here. Now, I probably wouldn't go any further than that because if we look at the weekly chart, we are at a weekly resistance level here. And we're actually in a weekly downtrend, right? So I think this potentially, you know, could have some room to the downside, right? In the midterm. But right now, guys, on the day chart, I'm liking this for a buy back up to these levels. And all I'm looking for, guys, like I explained with the last trade, we're looking for daily direction. I also like the trade to be supported by the weekly view. And then I'm looking for H4 and or H1 for entries. Now, it just so happens the H4 and the H1 level is this level here, right? If we get a break of this level, right, I think we've got a really nice trade back up to these highs in here, right? If it breaks this level. And if we look on the H1, it's exactly the same level. Price has just chopped about all day, right? We've now had that news. And again, if you have bullish US dollar data, as in it should make the US dollar strong, and the technicals ignore that, and you still get a bullish candle like this, then that's a very good sign that price wants to push higher as well. And like I say, if we get a break of this level, guys, I will start buying silver, right? Start buying in here, stops below here, take price up to here. All right, so as you can see, guys, I just put my alarm in. I've got my alarm there. As soon as that breaks, I will be all over that like Bruce Lee. We might even get a break at the finish of this hourly candle, guys, all right? So yeah, they're the trades that I am looking at, guys. Let's take a look at what you guys want to look at. So gold. Okay, so let's take a look at gold, guys. I know it's super well traded. And let's do a top-down approach with gold, right? And when I say a top-down approach, I mean, let's start with the real higher time frame view and then work our way down to understand what we can do with gold. Now, the weekly chart, actually, I've got to show you the monthly first, because the monthly is crazy overextended, right? Look at the moving average 20, right? If I pulled up the RSI, this would be above 70, right? This would be super overextended. But I can see that anyway because it's so far away from the moving average 20. And remember, the moving average 20 is the mean of that chart. And price will always come back to the mean, like always, right? You know, obviously the mean catches up with price and it might only pop down to here, right? But it will catch up with the mean. Now, the weekly is just suggesting everything is very overextended. But then look at this candle. It's just buying, buying, buying pressure. Okay. Now, if we look at the weekly chart, it will be very interesting to see how this weekly candle finishes. Right now, it's looking bearish, but we've still got another 2 days. Right. So we can't make any judgment on this. But from a weekly point of view, right, we're clearly in an uptrend, right, and we have bullish candles. Okay, but I have to trade from an area of value, guys, and so should you, right? If I start buying gold up here, right, where are you going to put your stop? Below this level, right? There's no value up here in buying gold. I would like to see a retrace. Okay, we've got silver breaking that level. I would like to see a retrace into somewhere like here before we start buying. All right, so everything's just overextended, overbought, right? Let's go to the day chart now. And again, right, we've had this, you know, reasonably large rejection wick here, right? This may suggest we have some room to the downside. And at the very least, I would want to start trading from the daily moving average. So let's say price makes its way back down to the daily moving average 20. If we get some bullish reaction in here, I would consider buying gold. Or alternatively, yeah, price comes back down to this level in here, right? This last piece of support, bullish reaction, and then we start buying gold. There's just no value in gold at the moment, right? There's just none. So let's see what happens. And you can see on the lower time frames that, okay, it's holding there. But on the H1, okay, all right. So it's still quite bullish. But again, we'll see what happens. But yeah, too overbought for me. There's no value in gold at the moment. All right, retrace into value. We can start buying. Right, what else we're looking at? A mean pound Japanese yen. Right, let's have a look at pound Japanese yen. Where are we? Let's take a look, guys. Now, again, I like sells here, right? If we look at the weekly chart, we are clearly in a downtrend, right? You do not have to be Warren Buffett to see this is in a downtrend, right? You can see price here. If we just track structure, right, we're in a downtrend. We're getting lower highs, lower lows, okay? And, you know, everything that I tell you guys is just the facts of the chart, right? This is not me creating anything or projecting anything. I'm just talking about the pure facts of the chart, right? And we are in a downtrend. We also, what I like about this last low is that this candle broke this last low and this piece of support here, right? So we're in a downtrend, we're getting lower lows, right? We've broken a key support level. And just look at that weekly candle, right? Mega super bearish. That is more bearish than Yogi the Bear, right? So I want to sell this pair and potentially, you know, back down to the next piece of support, right? Not rocket science, yeah? Back down to this level and this 185 psychological level. Now, the day chart supports this idea. Okay, now if again we just follow structure, you can see that we are clearly in a downtrend. All right, lower highs, lower lows, right? We're in a downtrend. Now, we're also at a very nice resistance level. We've got this piece of support here as turned resistance, and we've got the moving average 20, which acts as dynamic resistance in this case, right? So this is a very interesting level for pound yen right now. I think this could be a very nice selling level. The problem with it is the candles are not telling me to sell it, right? Now, this is super bullish, and so far this is a pretty bullish candle. Again, the day candle hasn't finished forming, right? Now, if the daily candle finished like this, I may not be interested in selling pound yen. But if we get a candle that finishes like this, right, bit of a rejection wick, right, then I would consider selling pound yen tomorrow, right? I mean, no rush to take a trade today. I will let the day chart tell me what to do tomorrow, right? I do the same every morning. I am like a robot, right, with my routine in the morning. So if we get a bearish candle, looks something like this, right? Sellers are coming into the market. I think pound yen is a nice sell trade, potentially back to these lows, if not further because of that weekly chart. And then sort of the last piece in the puzzle, guys, is what I want to see is a breakdown on a lower time frame. So weekly, daily, give me my direction and tell me I can sell pound yen. And then if we look at the H4, right, nothing is telling me to sell that. Okay. If we look at H4 structure, we're clearly in an uptrend, right? And chances of us getting a breakdown in structure could take hours, right? Literally, you know, days even. So sometimes we can go down to the H1 chart and you will see there's a really nice area of just contraction of price, right? So you've got all of these buyers, right? This is like the sentiment, the psychology of the market. You've got all of these buyers just piling into the market. Everyone's jumping in on this trade, buying, buying, buying. And then it hits a really nice resistance level, like I just showed you on the daily. And it's not rocket science that you are going to get this, right? Because you have sellers at a really nice resistance level. And then you've got all of these buyers that have piled into this bullish move. So what you end up is just with this sideways contraction of price. It's a box of indecision, if you like, right? There's no winners yet. You got buyers, sellers, buyers, sellers, buyers, right? There's no winner here. So what I would be interested in is if we get, because we're at such a nice resistance level, if we get a breakdown of this area of indecision, right, then I would be looking to sell pound yen. Okay. And what I really like, guys, is when you get this combination, you've got the moving average 20 coming round. Now, if price breaks out of this small contraction range, it will also break below the moving average 20 as well, right? And if we get this combination, it is such a nice setup. And it's also a nice setup because price is so overbought here that, you know, it's just traveled such a long way in such a short time But when it does break down, or if it breaks down, you've got so much room to move into, right? We love this. I love this for a setup. So pound yen, Mina, I would look for sells if that breaks. I do want the daily candle to support that idea as well. So yeah, there's pound yen. Lots of people looking at pound yen. I'm sure you're all looking at that same level. Right, what else are we looking at? Okay, okay, we've looked at gold. We've looked at pound yen. Anything else, guys? US dollar, Swiss franc. Okay, let's have a look at US dollar, Swiss franc. Now, this is kind of hit a level, right? If we go to the weekly chart, now, at the start of the day, I wanted to buy US dollar, Swiss franc. I was seeing Swiss franc weakness, right? Now, the problem with it now is we're at a weekly level, right? Clear as day, we're at a weekly level. And once we're at a weekly level or even a daily level, right? If we're in an uptrend and we're hitting a resistance level, I know I'm not going to have a trade with that pair for some time, right? I'm just not. I'm not going to buy into resistance. That's what crazy people do, right? And I'm only crazy at weekends. And vice versa, right? If you're in a downtrend and you're hitting a support level, I'm not going to trade it, right? You know, it could be days, weeks before I trade it. Okay, so that's the problem with US dollar, Swiss franc, right? We're clearly in this lovely uptrend, but we've hit a resistance level. So just no trade for me. Yeah, and you can see that on the day chart, right? You know there's sellers here. Sellers have pushed it down to here. Sellers come in again, pushed it down to here. There are sellers in here again, 100%. Right? There are sellers in here. You know, don't even think of it as a resistance level. Think of it as a selling level, right? So not interested in buying into that whatsoever. Right, what else are we looking at? So we've got lots of US dollar pairs. Let's have a look at the NASDAQ. Yeah. So let's take a look at the NASDAQ. So I do trade indices, guys. I do trade commodities, but mainly Forex. But yeah, we do keep an eye on everything. And you know, the Forex pairs are all affected by what the indices do, and they're affected by what some of the commodities do, right? So of course I look at them. And let's do a top-down approach again, guys. And this is where we're at, right? We are in an uptrend stroke range, right? And we've been in this range for 1, 2, 3, 4, 5, 6, 7, 8, 2 months, right? 8 weeks, 2 months. We've been in this range, right? And which basically means there's uncertainty in the market. You basically have as many sellers as you do buyers, right? Every time buyers come in, sellers push it back down, buyers push it back up, sellers push it back down, and so on, right? We're in this range. Now, this is the weekly chart. So from a swing trade point of view, I want to see a break to the upside. That would be a continuation of trend. And I think we can carry on with the indices, right? Buying the indices. Or we get a breakdown of this level and we start selling the indices. Now, just GDP figures, right? There's no growth anywhere, right? In any developed country, even not so developed country, there's so little growth anywhere. Okay, so, you know, that would suggest we will get a breakdown of the indices. But again, I'm not going to let that guide my decision. I'm going to wait for the chart to tell me, right? If it breaks this way, I sell. If it breaks this way, I buy, right? And that's broadly speaking on a swing trade point of view. Now, on a daily point of view, it's a bloody mess. But it's just, I mean, just look at this price action. Look at that. And just all these gap ups and gap downs. That's what's known as a bloody mess. Stay away. But it's still within this higher time frame range. But generally speaking, right, you can trade the top of the range back down to the lows and the bottom of the range back up to the highs, right? But I would still want to see, I would still want to be with trend and structure. So you can see, right, really here, yeah, there's big, you know, there's a last daily low, if you like. If we got a bearish candle that broke through this level, then there's enough confluence there to take price lower, right? And that's the trade I would consider. I wouldn't look to buy into this because this is the top of that range, and price has shown you time and time again that it sells from this area, right? So I'd potentially look for a break of this level and to take price lower. Once we get down here, I want to see the same, right? Price comes down, perhaps we get some daily indecision, bang, we get a structure break, look to take it to the highs of that range. All right, so NASDAQ, that is what I am seeing, guys. Guys, don't forget, if you enjoy my analysis, I've got my own YouTube channel, guys, Simply Forex, so please come join me. We would love to have you. What else are we looking at? Right, we do one more dead quick. Right, a few people wanting to look at pound US dollar. I can sum this one up in a nutshell, right? Contradiction. Right, and that's a word I keep using with the US dollar, right? Contradiction. If we look at the weekly chart, right, you would sell that, right? You would. We're in a downtrend, lower highs, right, lower lows. We're at an area of resistance, and we are seeing bearish candle, bearish wick, right? Everything suggests on the weekly chart, we could come back down to this 1.22 psychological level, right? Now, that's the weekly chart. If I show you the daily chart, right, we are in an uptrend, right? We're getting higher lows, higher highs. Okay, these highs are holding, so maybe it turns into a bit of a range. But before that news come out, right, we was in an uptrend stroke range. We was above the moving average 20. We had a super duper bullish candle. That is more bullish than Bullseye. It's an English old TV series. Anyway, yeah, but everything would say I would buy that and I would take price back to this 1.25 level, right? So you've got the weekly telling you to sell, you've got the daily telling you to buy. And when I enter a trade, guys, I don't want this contradiction. I want these two to move harmoniously together like they've been married forever. Probably not that harmonious if you've been married forever. Anyway, something that's very harmonious. All right, guys. So yeah, that's what I am seeing with pound US dollar. And that's across all US dollar pairs, guys. There's this real contradiction, and this, you know, these inflation figures have not helped that. So yeah, there you go, guys. I'll leave it there, guys. My time is up. Thank you very much for all your questions and spending your time with me. Cheers, guys, at Trader Nicks. Thank you very much, and I'll see you soon, guys.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show. All right, guys, I'm back. You couldn't get rid of me. I'm here. Tom, great session. Appreciate him for coming on. Guys, make sure to go subscribe to Simply Forex on YouTube. The link was dropped in the chat by our producers, so make sure, free value there. You guys know how it goes with these shows. We bring traders on from all over the place with many different trading styles. And our goal is to kind of be the thought hub, if you will, for active traders, whether you trade futures, whether you trade Forex, stocks, whatever you trade. We just hope that we add some value to your trading journey each and every day that you tune in. If you're a big fan of the show, make sure, yesterday we had Alan on. He's been a long-term supporter of the show and actually joined us on stream. And he said that he realized the other day that he wasn't subscribed to the channel. So if you, it happens, right? You just watch somebody because it keeps popping up on your screen, but then you realize one day you're like, wait, I'm not actually subscribed to them. If that was you, if I just called you out, do me a favor, subscribe wherever you're watching and let us know that we caught you. Just, if I just caught you, let me know. Also, check this out. Just found something very interesting. We just finished a new tool on the stock box. This is really cool. This is the consumer discretionary to consumer staples ratio. And another way of thinking of this, I'm not sure what to call this yet. I was just playing around with this before I hopped back in here. I think I might change the name again, but I think for now, I'm just going to go back to this. Consumer discretionary versus staples. It's a long name, but that is really what it is. So the consumer discretionary versus consumer staples ratio is actually really fascinating for understanding the risk sentiment to markets. So let me show you this. This is XLY versus XLP. By the way, silver is absolutely ripping, and that's awesome. What is XLY? What are XLP? Well, let me show you so we know what we're working with here. XLY is an ETF that tracks consumer discretionary stocks. Now, consumer discretionary stocks are things like Nike, Amazon, Tesla, Lululemon, right? Things like that. What are those types of stocks? Those are wants, right? Actually, maybe this is another way I could title this. Wants versus needs. Now, consumers want a Tesla. They want a new pair of Nikes, but do they need those things? No. Needs are your consumer staples. Walmart, Coca-Cola. Companies, I guess Coca-Cola is a weak example, but grocery stores, things like that, things that you need to consume, right? People need these products. Now, when we compare the two, the relative performance, which is something I'm talking about a lot recently, is very interesting, and something fascinating just happened. Consumer discretionary has been leading the charge. Now, what does this mean? What does this chart going up means? It means that discretionary stocks, aka wants, are outperforming needs. People are out there spending a lot of money on things that they want. And believe it or not, that's not always an option for people. Sometimes consumers, they're hurting a little bit. Like, for example, when inflation was really big, like when we were peaking into like 8s and 9% for the US inflation data, it really hurt the consumer and people were really cost conscious, right? In that environment, people, staple stocks probably outperform discretionary. Now, what we've seen recently is discretionary has outperformed, but look at the recent shift in this chart. Does this make sense? Do you guys understand where we're going with this? This is showing you that recently needs, quote unquote, staple stocks are actually performing well relative to wants, aka discretionary stocks. Now, as a stock investor or a stock trader, or even as a gold trader, or even as an index trader, this is a very cool chart to study. When you see this data starting to trickle lower, that would suggest that you're more in a risk off environment. When this is rising, that would suggest you're more in a risk on environment. Does that make sense? Type yes in the chat if that concept makes sense. If you understand the chart that we're looking at, this is, again, the consumer discretionary versus consumer staples ratio that we just added to the stock box. So really cool stuff. Also, if you are an Edgefinder user and you're interested in getting the stock box, this is a new tool that we built. It's a little bit more tailored towards stock investors, traders who want to dive more into stocks, options, ETFs, things like that, the stuff that I trade a lot too. If you don't have the stock box already, just so you know, if you're an existing Edgefinder user, you do get this significantly discounted. If you'd like some information about the stock box, we'll drop a direct message link where you can speak directly to our support team who can get you that existing user discount. We give substantial discounts to people who already have some of our products. We understand, this is another purchase that you have to make, and we're not trying to, it's just that at the end of the day, these things are very costly to build and maintain. This is a new tool. People were requesting stocks for the last few years, and we are now, I'm going to say it, the stock box is actually getting to a point where it's like, okay, it's coming out of the super beta version, and it's now just straight up like early version, right? So we've been adding a lot of tools to this. Like, for example, when I'm looking at stocks, I love having the stock box. I can look at income statements for my favorite companies. I can look at PE ratios. Here's an example. Like, I was looking at a stock. I shorted puts on PayPal the other day or yesterday. And PayPal is a company I really like. I like PayPal for a long-term buy and hold kind of stock. So why do I like that? Well, one of the reasons is look at the price to earnings to PayPal. Relative to its own historical valuation, PayPal is relatively cheap. Now, when I say relatively, here's the stock, at one point valued at around a high 40s, low 50s PE ratio on a 12-month basis. Well, we've trickled down. The valuation has come down. Now, the stock price has gone up a little bit, but the valuation still is relatively fair, in my opinion, compared to the stock earnings. Does that make sense? So I love PE ratios. I love free cash flow ratios. So if we pull up, do we have PayPal on here? Let's see. We just got this new chart here. The free cash flow of PayPal can be pulled up here. We just added the price to sales ratio. So we're adding all of these charts to make stock trading and investing a little bit easier. Here's PayPal's price to sales. You can see there's a nice trending up kind of level here. The price to sales ratio has remained relatively non-threatening. So I like this. So that's something I just wanted to point out is the stock box. We've just upgraded a whole bunch of new financial data. We've also added that new consumer discretionary versus staples indicator that I just got done discussing. And yes, like I said, if you are an existing Edgefinder user or member of our VIP group, you can get access to the stock box, super low cost. We've been investing a ton of time and energy into building out the stock box, and it's going to get way better by the end of the year. I'm so excited. It's already gotten pretty cool. It's going to explode this year. The year of the stock box is here. NASDAQ down 1.10% still, not really regaining the losses here very much. Again, huge sell-off on NAS. That's a drop over 1.5% at one point. S&P 500, similar story, had a 1.25% drop here. Meanwhile, Dow Jones down 0.9 and the Russell down 1.5. I mean, this has bounced back a little bit. At one point, Russell was down almost 3% on the day. So, or from this recent high. So really big drop there. The VIX is up here a little bit today, about 5% move higher on the VIX at the time. Let's see. And there's gold. Again, just understand, I mentioned this earlier. I mentioned that I think gold would snap back after CPI. It's too early to say confidently, oh yeah, look, it snapped back. But so far it's got a good start. And silver is actually positive today. So my silver trade looks incredible. My TLT trade looks like hot garbage. So TLT, this one stinks, down 1.4% here today. So I just want to even out, not just going to brag about the ones that are working. TLT not working for me, kind of frustrating. With 4 minutes to go on TLT, I'm going to take a closer look to see what I want to do with that position. But silver is running hot. Really good start here to the trade. And if we can get back to these highs, guys, what I'm going to do is I'm going to trim my risk. So this is something I like to do. So we had this intraday spike low for silver. What I'd like to do is that if we can get a push towards these highs, right, I'm going to take that stop loss and I'm going to trim it. So I'm just going to take some risk off the table. Does that make sense? Yeah. Have you found a take profit for silver? I don't use a take profit. I trail stops on positions that I am in. So I will not be taking profit, and any updates or changes that I make to the trade will be shared inside of our Discord VIP room. So if you'd like to see the updates, if you'd like to see when I'm out of the trade, things like that, you can join the VIP room. Bitcoin's down 1% here today as well. Bitcoin not able to catch any kind of break here. I mean, we've just really consolidated heavy. So, believe it or not, I mean, this has been going on since November. You've had a lot of drama in between, and yet Bitcoin rose as much as 19% at one point and is now, pretty much back to where we started several months ago. Really not a big, decisive push one way or the other. There was some really big hype around, Trump and Elon, who seem pretty pro crypto, but that has kind of fizzled out a little bit here recently. I think more so just because there's a little bit of uncertainty. Here's my opinion on this, guys. Risk assets, I think, are going to probably chop around and be indecisive for a little bit. But once Trump and Elon and the current administration kind of find their footing a little bit with all the tariff stuff, once that stuff is no longer uncertain and it just becomes kind of news, I do think that the markets probably rally higher. I think that right now markets are wobbly, as they usually are with a new administration, whether it's Trump, Biden, whoever. Usually the market's a little wobbly as things get going, and then they find their footing and they overall do okay. So I do think that I still like the upside for indices, but I'm just going to stay patient. Hey, Nick, a friend of mine is asking why they should buy the Edge Finder or join your Discord community instead of just watching your stream daily to check out the Edge Finder. In blue, is your friend you? Yeah, no, we get people like that all the time who comment like, hey, should I, that's like the asking for a friend meme. But yeah, no, if you are just tuning in to watch and catch a glimpse of the Edge Finder here and there, you totally can do that. I would just ask, like, how serious do you take your trading? Like, are you going to try and, what if I go on a vacation for 2 weeks? And, if you're a serious trader, building your trading strategy around trying to, scroll through videos to catch glimpses of data from a software tool, that, yeah, I mean, I guess you could do it, but it's, again, depends how serious you're taking your trading. But yeah, no, I mean, the goal of sharing the Edge Finder is, the Edge Finder should be a tool that I could pull up and it adds commentary, adds value to what we're discussing. As long as that is the case, I believe that adds extra value to my content. So the Edge Finder will always be in videos, but if there's something specific that you like to look at, like, for example, a lot of people got really hyped up about the carry trade scanner. I had no idea people like this stuff so much, but I guess there's a lot of Forex traders out there who are frustrated by the idea of swap. So just a quick touch on this. So swap payments, right? You guys familiar, for Forex traders out there, what I'm talking about? When you hold a position overnight, you get charged or credited a small amount, right? Or a large amount, depending on what it is. People don't know about that stuff. They don't understand what's happening. Why am I getting charged for holding a position? Well, did you know you can actually not only understand why that's happening, but you can also calculate more cost-efficient ways to trade Forex. Again, it's actually substantially different. If you understand how to calculate swaps and you have something like the carry trade scanner where you can study, like let's say, okay, ready? Let's say I'm really bullish on the dollar, okay? I'm going to search up USD in the top right. And if you have Edgefinder, I encourage you play with this. This is cool. It's at the bottom of the list. Just look up on the Edgefinder, go to carry trade scanner. And look at this. If you are bullish on the dollar, right? What would you want to, like, let's say you're bullish on the dollar, but you don't want to get charged a ton of money for holding a long-term dollar bullish position, right? What would you want to do? Well, if you are bullish on the dollar, you probably would get the most divergence in interest rates from two central banks trading something like dollar yen or dollar Swiss. Now, what do I mean by that? Well, the divergence, look at the central bank, the base currency, which is the US, and the quote currency, which is the Swiss franc in this example. If you hold dollar Swiss franc long, the divergence, this number minus this number, is plus 4% when you are buying the USD CHF. That means you get actually paid to hold dollar Swiss on most reasonable brokerages. Most reasonable Forex brokerages will pay you. They're not paying you. I mean, it's just interest rate differential, the two interest, overnight stuff. You actually get credited to hold dollar Swiss long. So if you're bullish on the dollar and you know about the carry trade scanner, you may choose to trade dollar Swiss, right? Because that's going to get you a more positive swap for holding. Now, swap's not the only thing to consider in your trading. By no means is that the case, but you want to at least be aware that if you're long euro dollar, right? Look, if you're long euro dollar, you're getting paid this in interest and you have to pay this in interest. So that's going to cost you. But if you sell euro dollar, you're going to get paid to do so on most reasonable brokerages. Does that make sense? Can we move on from this topic? Does the carry trade scanner make sense? Type yes in the chat and I can move on from it. But yeah, it's a really powerful indicator to have on your screen, the carry trade scanner. If you're a Forex trader, this is a need. This is not a, oh yeah, I should consider swap. No, it's literally could be the difference between profitability or losing money in the long term. Because if you are like, oh yeah, no, I'm just going to short dollar yen. Look, there may be times to short dollar yen, but you are going to pay an arm and a leg to hold that position. Okay? You need to understand swaps. You cannot be a professional Forex trader and not really understand swaps. There's no such thing. You have to understand how that functions. Because that's not even like, oh, picking direction or strategy. That's literally, it could just eat away your profitability if you're trading in the direction of very costly negative swaps and holding it for weeks. You might have a position. Let's say, check this out. Let's say you shorted dollar yen, right? So I'm short and the market does this. And then you close the trade, right? So you shorted here and you closed here. But let's say that this period was like 30 days. Guess what? In that 30 days, you might have made a profit on this, but you also could have lost out overall because the swap was so expensive. Okay? That's something to think about. It is a substantial difference maker. If I could bestow upon that to one person in the audience today, think about swaps if you're a Forex trader. It's really important. If you're not a Forex trader, interest rate differentials can still be very interesting and still be very, worth knowing about. But really, that is critical for Forex traders in the audience. If you're somebody who's bullish on gold also, like if you're somebody who longs gold, you should probably not do that on a CFD brokerage because it's really costly to hold longs on gold. The swap there is crazy and you don't even have to you don't have to do that at all. Okay, James is going to be joining us here in a second. Before we do that, let me just remind everybody, if you want to do a last second entry, well, actually it might be too late, but you can still join the Telegram channel if you want to vote. So we are about to do an Edge Finder giveaway. The way this is going to work is that we had people join the Telegram channel and submit their favorite trading meme. The best rated, funniest trading meme, the person who submitted that is about to get a free copy of the Edge Finder. But we need you guys' help. We need you guys to stick around. James is going to take over the show. We're going to do a meme segment. Literally, this is my favorite thing ever. We're going to do a meme segment on the live stream. And the best meme that gets us laughing the most, you guys are getting a free Edge Finder. If you want to vote, we'll drop the link. Oh, there it is. Link is in the chat right now. Make sure, join the Telegram channel if you would like to vote on the winning meme. We need you guys' help on this. Okay, so let's take a quick break here. Thank a sponsor, and then we're going to swap in James here. I'll join you in just a second, James. I'm going to run to the restroom, and then I'll be right back.
2025 is here, and to kick off your new year of trading, you can get access to our free A1 Trading Telegram channel. Inside, we share Edge Finder data, free trading courses, market forecasts written by our in-house traders, and free trade ideas on Forex, indices, gold, and more. And if you're more into the stock trading world, we have a whole Telegram channel dedicated to just that. Start your new year off right by joining the A1 Trading Telegram channels completely free. Links can be found in the description and in the live chat. Now, back to the show.
What is going on, everybody? I'm going to share my screen here in just a second. I'm going to have to share my whole screen because we're going to be switching tabs a whole bunch. But yeah, like Nick was saying, we're about to do a different kind of giveaway. This one's more of a competition style, and everybody that is watching right now can be a part of it. We got a whole bunch of submissions from you guys. We had 50 plus submissions of your favorite trading memes, and I've gone through. A lot of them were really good. A lot of them were unique, funny. I've compiled what I think were the best 10. There were a lot more that didn't make the cut, so this is definitely something that we can do again. But let's go ahead and get straight into it. So I'm going to present here, and I think that this is going to work. I can no longer see the StreamYard, so I don't know if my screen is shared. I think it is, but okay, here we go. Meme the market. You guys submitted. I didn't ask for your names or anything. I did ask for emails, so I do have a little bit to go off of in terms of who submitted what. So not everybody's name or everything is on here, but we'll be able to figure out. So this is entry number 1, submitted by Abdel. And remember, we are going to be voting on these at the end. So join the Telegram. We're going to vote 1 through 10. Which one was your favorite? And here's the first entry.
James, I think we're missing sound. You may need to share it in StreamYard. Did you already?
Whoops. Yeah. I'm not sure.
It's like right when you share screen, it's like, do you want to share audio?
Okay, let me stop sharing and share screen. Oh, to share audio, share tab instead. Okay. Okay, we can do that. No problem. All right, try number 2. Let's do this. And we're going to share Okay. Audio now?
I think so. Let's see.
Oh, wait.
Yep.
Okay. Great. All right.
Yes. Il solde. Bumpy.
Love the Western music.
That one's a classic.
That's a classic right there.
And the music makes it so much better. So that's going to be our first entry. This poor guy, he can never catch a break. Entry number 2, we have submitted by Keith. And this was a pretty good one, guys. I really enjoyed this one.
JP.
Good afternoon.
That's very relatable.
That's all it takes.
Relatable.
All he has to do is walk up to the podium and breathe into the microphone. So that's our second entry submitted by Keith. Another pretty good one. This one was one of our later entries. And this one was pretty unique. This one was pretty original. I liked this one.
Okay, guys, so here we can see that it created a higher high, higher low, higher high, higher low, higher high, higher low, lower high, higher low, equal high, and then it created a lower low, so that's the change of character. So you wait for retracement at the 786 or 5618, and you start shorting it, and it's going to be downtrend from there. Lower high, lower low, lower high, lower low, and then there's the crash, bear market.
He's shorting a whole building.
Yep, traders just view the world differently. Entry number 3, that one was submitted by Danielle. This one submitted by Aman, another relatable meme, I think, for a lot of people out there. Twice. Really? Says POV, your friend uses a new word in the conversation. But he has never even heard of a profit.
Market is very contagious, but I still made profit. What does that even mean?
That was entry number 4. That one was submitted by Aman. Moving on to number 5. And really quick, I'll go back through these. We won't watch them all again, but that's why I included the image so that you can kind of get an idea of what the meme was, so you can remember which one was your favorite. Because in the poll, I'll just list 1 to 10. You pick whichever one was your favorite. This is our only image that made it. This one might be a little dad humor-ish, but I enjoyed this one. It kind of reminds me of like a newspaper comic, but you've got one of the market guys looking outside. He says, "Snow is falling," and all the other market guys are freaking out, trying to sell snow.
Yeah, I love these two. They're like just misinterpreting what somebody says.
That one was submitted by David. Number 6, we have one by, I don't think this was actually their name, but I just took the first couple letters of their email. So we're going to call him Sebi. This is entry number 6.
I just died of your arms tonight.
I'm not going to play the music for too long because
Yeah,
my
good
kid is
point.
taken down. But there you go. You got the idea. When you sell at the all-time highs, but gold keeps making all-time highs. That one's pretty relatable, pretty relevant for what's going on.
That's pretty recently relative for sure.
Pretty recent one. Entry number 6. We got a couple more to go through here.
James, I'm gonna hop off. I gotta jump on this podcast, but I'll come take the other side of the competition here.
Sounds good. All right, so we're going to keep on looking at the submissions. We got a few more left. We got, I think, 4 more left. Entry number 7. This one may look a little familiar to Chandler or anybody else that saw it. This was submitted by Eric. Yeah, not going to play the music for too long. This one was actually posted by Chandler yesterday, I think. Or maybe it was posted today. Or maybe this is an older one. Chandler, you'll have to let me know. Because we did have CPI today. POV, you're having a good trading week. CPI today, he's giving you that look. CPI can change everything in an instant. That inflation report, good old JP. Entry number 7, thank you, Eric, for submitting that. Entry number 8 by PMD. Let's take a look. When my trade is 5 pips away from take profit, he's doing everything in his power. We'll watch it one more time. Doing everything in his power to get that chart to move higher. Not quite enough, though. All right, we've got 2 more. 2 more. Reminder, guys, you can join the Telegram link either in the description or we can drop it in the chat right here. We are going to vote on these in a second. We've got over 770 people watching right now. So if all of you guys join, we're going to have a clear and decisive winner. Go join the Telegram. Make sure that you guys vote on this. We're going to get voting here in just a couple of minutes. But first, we got 2 more entries to get through. Entry number 9, submitted by my bad. I think that was just the first couple letters of the email. I'm not even going to try and say that. Here we go. Nice starting and all for nothing. When I first watched this one, I was wondering, where is this going? This seems pretty normal. Just your basic charting, looking for that level of support and then hopefully to break out higher, and it just completely breaks through. All of that charting is for nothing. I like that one. All right, that was entry number 9. We have got 1 more to go here. Entry number 10, JGME. I see some minions here. All right.
Bueno. Piñu. Bueno. Piñu. Bueno. Piñu. Ah, Luca. Bueno.
New traders willing to get into anything other than healthy trading habits. All right, so that was our 10. Reminder, guys, you can vote now, or we will vote in just a second here in the Telegram description below or in the chat. Here are the options. There is a poll that is about to go up, and it's simply going to be listed 1, 2, 3, 4, all the way down to 10. You just click which one was your favorite. So, was your favorite this poor guy that can't ever catch a break? He sold his shares and then Bogdanov pumped it. Is it Jerome Powell stepping up to the mic? He says, good afternoon, and the markets immediately go into a frenzy. Trader who can't even look at anything the same anymore. He's looking at the building. He's seeing higher highs, higher lows. The guy that has never even heard of the word profit before. The trading guys taking it too seriously. Snow is falling. Sell snow. Sell, sell. This was gold making all-time highs and continuing to make all-time highs. You sell gold at all-time highs, and every day it's just new all-time highs. You were having a good trading week. CPI today giving you that mischievous little look. Doing everything in your power, like blowing on your monitor to make the chart go higher. 5 pips away from take profit. This guy doing all of his charting the right way, making his chart look nice and clean, just for it to absolutely crash through everything that he put on his screen. And the minions, the new traders, doing everything in their power to trade in the most unhealthy way possible. Those are our 10 submissions. Let's see, do we have, and I'm going to put the poll up right now. So which was your favorite? 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. All right, which was your favorite meme? And sent. All right, poll is now live, 1 through 10. Go vote on the poll right now. I'll go through them really quickly, just one more time. So these were our submissions. Sells, Bogdanov pumps it. Jerome Powell walks up to the mic. He says, "Good afternoon," and the entire market crashes. Higher lows on the building. Never heard of profit. Sell snow. Gold all-time highs. CPI today, again, very relevant for what was going on today. Blowing on the monitor. His nice clean chart getting absolutely ruined. And new traders. Go vote now. Go vote now. In the meantime, Darren, yes, you can join. Here's the link. The link is in the chat. The link is also in the description below. It is completely free to join. It's just our Telegram service. We constantly put, in fact, you know what? Let's show off the Telegram a little bit. So I'm going to stop sharing this. I'm going to share my entire screen in a second so that we can go over the Telegram. So Chandler, if you don't mind putting this up here for me. You can. I think you should be able to see this because it's my whole screen. So this is the Telegram. Let me get this out of here. This was a joke. True Trader FX. I was curious to see what kind of garbage they were putting in their Telegram. It's nothing good. These are good though. A1 trading is good. True Trader, not good. Anyway, this is what our Telegram looks like. We have some little market reports written up by Frank. We have our chart of the day series that Chandler and I have been doing. So you can watch Nick and sometimes other people break down their favorite charts of the day. We've got Edge Finder screenshots in here. Sometimes we have special deals. You know, you'll get alerted when we have sales, things like that. Look, right here, 30% off the Edge Finder. This was last week, so this is probably not still live, unfortunately. But if you were on the Telegram, you would have known about that. Chart of the day, our live stream schedule, some gold analysis, Edge Finder screenshot about silver, our retail sentiment for the day. This was a couple days ago, but again, if you were in the Telegram, you could have got a free look at all this nice retail sentiment. Chart of the day featuring Chris Pulver. We love Chris over here. CTO data, talking about oil, gold, stock indices. Lots of really useful stuff. Really useful stuff here in the Telegram. And we're playing games too. 48 votes. Come on. We got more people in there than that. I'm not going to open up the StreamYard. I almost did. to see how many people were watching, but I know it's more than 48. I know it's a lot more than 48. So 51, there we go, 300 views. Join the Telegram, guys, one more time, free to join. If I were going to vote for one, I'm going to vote in a little bit and reveal the results. But if I were going to vote for one of them, which one would I vote for? This is the only image that made the competition. So I feel like there should be some respect put on this one. This one is subtle. Sometimes subtle is the funniest. I like that one. I like this one a lot too. This one is unique. It's got a few different animation styles. It's got Jerome Powell. I actually, you know what is funny? Is I saw 3 different versions of this exact same meme. He walks up to the podium, says good afternoon, and then the market crashes. I saw 3 different versions, 3 different animations of that exact same thing happening. But ultimately, this one was my favorite. These are classic too. These are well done. Man, I think this one is my favorite. I like this one too. Very relevant to what's going on right now. Also another relevant one. But yeah, I think this one is going to be my favorite. I'm going to vote in a little bit because I don't want to reveal the results yet. I want to let people, you guys see my cat? I don't know if you can see that on my desktop. I don't want to reveal the results yet. 68 votes. I will vote and reveal the results at 75 votes. That seems fair. Come here, cat. Let's see if I can grab him. He's being a little quick. Nope, he got away. Come here, buddy. No? Okay. I wish I could read the chat. I will read the chat here. Hold on. I'm going to do this, and then I'm going to do this instead. There we go. In order to share the Telegram, I had to share my entire desktop, and I don't want to show the back end of all the secret stuff Chandler and I are doing back here. Alan, what's up, Alan? Guys, we had Alan on stream yesterday. And he was awesome, and I think he's going to keep coming back. I think Alan just might be a new stream regular. Max, I recognized your name. I recognized yours when I saw it. In fact, I know I didn't pick yours, but just for fun, because you're a stream regular, we can take a look at it. Dang, can y'all hear my cat absolutely whipping around my living room right now? Okay. I saw the name Max B, and I recognized you. Here we go. Max B. Let me see here. Oh, Max. This was a good one. Max, that was a good one. And you know what? I think I initially had that one in the competition. Sorry. I think I initially had it in the competition, but I liked the other Jerome Powell one just a little bit more. But that was a good one. Contender for next time? I think so. I think that might be a contender for next time. That was a good one, though, Max. That was a good one. Read through a couple comments here, and then I'm going to go vote. Lee James says that's the winner. Would it have been? I can tell you this is not the last time that we're going to do this. And if you submit, that's a good one. So if you submit that one for next time, that one's, I think that's a, Lee James. Lee thinks that's the best one. If you submit that one next time we do it, I have a pretty good feeling that one's going to make the cut. Okay, let me share my entire screen again. Oh, actually, I can just share the Telegram only. I think y'all can see this. We have 81 votes in. If you want to get your final vote in, do it right now because I'm about to vote for my favorite. And I think my favorite was number 2. Number 1 was the overall favorite, however. Number 2 was second. Very, very close behind it was number 10. That was the Minion one. This was the Jerome Powell one. But Bogdanov pumping the stock immediately after it was sold was the overall favorite. It's interesting, though. Everything did get a vote. That's good. Everybody had slightly different tastes. You can see that every meme here got a vote, and every meme was somebody's favorite, unless you just completely forgot what you were voting for, or you're not even watching the live stream right now, and you're just a member of the Telegram, and you just clicked the number. That is also very possible. But yeah, overall, number 1 was our winner. So let me see who's. Oh, can you see this? No, you can't. Okay, good. Oh, that's funny. You can see my mouse moving around, but okay. Individual number 1 response. It would be cool if you're watching right now. Let me see here. Arad, are you watching? What's Chandler got to say? I don't know because it won't open. This is weird. Chandler, you got to text me. My entire Discord is like totally bugging out right now. Oh, good point. Powell is on. Let me do that. Congratulations to our winner, guys. I know that I've been stalling for time here a little bit if it wasn't obvious enough. But Arad, congratulations. You are our winner. I have your email, so I'm going to email you with your information. You just won an Edge Finder. Thank you to everybody that participated. We got a lot of entries. This was a lot of fun. I enjoyed putting it together. This will not be the last time we do this, I promise. So if you've got your memes, stock them up, save them, max, submit that one next time. That one's probably going to get in. That one will get in, I promise. But yeah, that is it for me. We're going to watch Jerome Powell until Chris gets here. I can't go full screen on that. Okay. All right. Wait. Oh, Chandler, you've got it. All right, Chandler. You can take it away. I'm out of here. Goodbye, everybody. Chris Pulver coming up next. Until then, we will wait on Powell.
Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled the Federal Reserve Semi-Annual Monetary Policy Report. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I will note that at the outset that this hearing has a hard stop at 1 p.m., which we will strictly observe. I'll now recognize myself for 4 minutes for an opening statement. Welcome, Chairman Powell. Thank you for being with us today. For the last 4 years, inflation has crushed Americans. Today, it takes $1.21 to purchase what just cost $1 in January of 2021, as measured by the Consumer Price Index. The erosion of Americans' incomes and thereby their savings was caused by a combination of irresponsible fiscal policy, supply chain disruptions, but also by, in my view, the Federal Reserve fighting the last war, staying too low for too long. Chairman Powell, you and I have discussed that previous hearings of the Fed, like many others, assumed that the pre-pandemic era of low inflation and low interest rates would continue. This belief was one of the reasons the Fed changed its monetary policy framework in August 2020, only 7 months before inflation began its 4-decade steep march upward in March of 2021. In hindsight, the adoption of the so-called flexible average inflation targeting appears ill-timed and ill-fitted for a post-pandemic world. As the Fed undertakes a review of its monetary policy framework, you must account for the lessons of the last 4 years and think about what's ahead over the horizon, not what has been. The Fed has made progress on inflation, but as the last mile seems the hardest. As Bank of America economist Stephen Juneau said yesterday, inflation is stuck above target with risks to the upside. In August 2022, with inflation raging, you gave a speech that echoed some of your predecessors as chair. You vowed to keep at it till we're confident the job is done. It's a vow you should fulfill. With this morning's confirmation that inflation is well above the 2% target at 3% and making move upwards, other economic indicators are positive. As you reported yesterday, a low inflation rate, solid GDP growth, and financial conditions continue to support expansion and investment. This is not a time to say that there are no risks, but some perhaps unseen. However, these risks in comparison to the risks of a resurgence of inflation present are modest. Given the already high prices due to President Biden's inflation, Americans simply cannot afford further price increases at the grocery store and gas pump. Such a resurgence would likely force the Fed to begin another tightening cycle, making mortgages, credit cards, and small business loans unattainable for many. That's why I urge the Fed to forge ahead with its monetary policy duties until you're confident the mission is complete and price stability has been restored. The fact is, over the past decade, we've witnessed too many distracting additional mandates, diluting the Fed's core mission of price stability. This is the reason we formed the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity that will be led by Chair Frank Lucas. The task force purpose is to ensure that the monetary policy actions of the Fed are put under a magnifying glass and prioritized for this committee. And I look forward to our first hearing of the task force. I now want to turn to some of the other Fed responsibilities: bank regulation and supervision. The Fed was created by Congress to be an independent agency. The intent is to insulate the Federal Reserve's monetary policy from political influence. Unfortunately, in the last 2.5 years of the Biden administration, the Fed took on serious liberties with its independence in the areas of supervision. In law, Federal Vice Chair for Supervision is to develop policy recommendations that then are been brought to the Board of Governors for consideration. In my estimation, over the years, you and the board have been too deferential to the statutory Vice Chairman for Supervision. Vice Chair Barr turned the Basel III endgame rulemaking into a partisan attempt to propose a massive hike on capital on American banks, making them less competitive. The Fed has a chance right now to get back on the right track and preserve its independence for the long-term benefit of the American people. And with that, I yield back. Chair recognizes Mr. Lucas, the chair of the Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force, for 1 minute.
Thank you, Mr. Chairman. While there are differences of approach in this room, a bipartisan guiding principle is that maximizing economic growth is the path to economic prosperity. It is the single greatest factor in delivering opportunity and improving the quality of life for the folks back home. The actions of the Federal Reserve and the machinery of monetary policy play an important role in economic stability. With the 5-year review of the monetary policy framework underway, I hope this will be an opportunity to evaluate the effectiveness of the Fed's toolkit and its vast influence on the lives of every American. The creation of the new monetary policy, Treasury Market Resilience, and Economic Prosperity Task Force will afford us the opportunity to dive deeper into this topic. Chairman Powell, thank you for being here. There are real issues that deserve our attention, and I hope today will be productive. I look forward to hearing your testimony on the state of the economy, where we're at, and where we're headed. Yield back, Mr. Chairman.
Gentleman yields back. The chair recognizes Mr. Vargas, the ranking member of the Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force, for 1 minute.
Thank you very much, Mr. Chairman, and thank you, ranking member. And thank you, Chairman Powell, both for your years of public service and for appearing before our committee today. As a ranking member of the newly formed Monetary Policy, Treasury Market Resilience, and Economic Prosperity Task Force, I look forward to working with Chairman Lucas and the rest of my colleagues to address these important issues. The research is clear. Independent central banks perform better in carrying out their mandates than politically motivated central banks. The independence of the Federal Reserve is crucial to achievement of this dual mandate goals to maintain both maximum employment and stable prices. And although this dual mandate has been criticized by some, it continues to serve Americans well. It has not prevented the Fed from making substantial progress on driving down inflation, all the while avoiding a recession, which many saw as inevitable. I look forward to your testimony, Chairman Powell, and I yield back.
Gentleman yields back. I'd like to turn to the gentleman from Michigan and yield to him for a point of personal privilege. Mr. Heisinger.
Thank you, Chairman Hill. And as we all know, all good things must come to an end. And I want to take a minute to recognize someone who is leaving the committee, but has been an integral part of the oversight work Republicans have done over the last 5 years. Although Nicole Vo is all of 29 years old, something that we tease her about on a fairly regular basis, I quickly realized that despite her physical stature, she was a force to be reckoned with. Her dedication to my team, this committee, her colleagues, and this institution are something that we all should aspire to achieve. And Nicole has effectively served in various roles, from a professional staff member right out of law school to now Deputy General Counsel in this particular Congress. And her time with the committee, Nicole has worked on or led investigations into Sam Bankman-Fried, the bank collapses of 2023, terrorist financing, culture and corruption at the FDIC, and the SEC's climate disclosure rule, just to name a few. And I've sat through her questioning, and it's fierce and tenacious and directed. Myself, my team, and frankly, the whole Financial Services Committee team can't thank Nicole enough for her work and what she has done on behalf of this organization. And like all good staffers, she has become a confidant, a sounding board, has the ability to say no in a very nice way, but in a very tough way as well. And although Nicole will be leaving the committee, her contributions will not be forgotten and are deeply cherished. So thank you, Nicole. We deeply appreciate all of your work, and I yield back.
Mr. Chairman, we welcome your testimony. Chairman Powell, you'll be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statement will be made part of the record. You're now recognized for 5 minutes.
Chairman Hill, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on achieving our dual mandate goals of maximum employment and price stability for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated. We are attentive to the risks on both sides of our mandate. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose 2.5% in 2000.
Mr. Chairman, can we ask you to pull your mic a little closer, please? Thank you so much.
Sure. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose 2.5% in 2024, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have declined in the fourth quarter, but was solid for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid and appear to have stabilized. Payroll job gains averaged 189,000 per month over the past 4 months. Following earlier increases, the unemployment rate has been steady since the middle of last year and, at 4% in January, remains low. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.6% over the 12 months ending in December, and excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. Since last September, the FOMC lowered the policy rate by a full percentage point from its peak, after having maintained the target range for the federal funds rate at 5.25% to 5.5% for 14 months. That recalibration of our policy stance was appropriate in light of progress on inflation and the cooling in the labor market. Meanwhile, we've continued to reduce our securities holdings. With our policy stance now significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the FOMC will assess incoming data, the the evolving outlook, and the balance of risks. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we can ease policy accordingly. We are attentive to the risks to both sides of our dual mandate, and policy is well positioned to deal with the risks and uncertainties that we face. This year, we're conducting our second periodic review of our monetary policy strategy, tools, and communications, the framework used to pursue our congressionally assigned goals. The focus of this review is on the FOMC's Statement on Longer Run Goals and Monetary Policy Strategy, which articulates the committee's approach to monetary policy, and on the committee's policy communications tools. The committee's 2% longer run inflation goal will be retained and will not be a focus of the review. Our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. We will take on board the lessons of the last 5 years and adapt our approach where appropriate to best serve the American people to whom we are accountable. We intend to wrap up the review by late summer. Let me conclude by emphasizing that at the Fed, we'll do everything we can to achieve the dual mandate goals Congress set for monetary policy. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you, and I look forward to our questions.
Thank you, Mr. Chairman. Chairman yields back. I want to recognize the ranking member of the full committee, Mrs. Waters from California, for a 4-minute opening statement.
Good morning, everyone. A welcome, Chair Powell, to our country is on the precipice of an economic disaster unlike anything we've seen in recent memory. While Trump promised lower prices for working class families, we're seeing the exact opposite. In fact, grocery prices are rising. According to the Labor Department, eggs are up 40%, more expensive than they were even a year ago. In my home state of California, we've seen eggs as high as $9 and more for a dozen. Inflation is rising, and it is up to 3% for the first time since June. And other staples are about to get more expensive as Trump levies new taxes on steel and aluminum. America's consumers and businesses are facing uncertainty and chaos. This is all because Trump and his unelected billionaire co-president Elon Musk are taking a sledgehammer to our economy and democracy. In recent days, they attempted to illegally kill the Consumer Financial Protection Bureau, the same agency created after the financial crisis of 2008. Since its inception, CFPB has successfully fought on behalf of working class families against abusive big banks and predatory lenders, and not to mention returned $21 billion back to families who were swindled. Chair Powell, you explained yesterday that with the CFPB shutdown, there is no agency to supervise big banks to ensure they follow consumer finance law. In the face of these illegal, cruel, and relentless attacks, Chair Hill, it is both urgent and critical that you immediately convene a long overdue hearing with CFPB Acting Director Vaught, members of Congress, and importantly, the American public deserves answers as to why Musk and his Doge minions are in possession of sensitive consumer information and what they are doing with it. Additionally, Trump is simultaneously threatening import taxes on U.S. companies that will increase the cost of groceries and other basic supplies for all. Trump is freezing funds for housing assistance and community development and whittling down the federal workforce so that his billionaire boys club can suck any of these workers' salaries into their own pockets. This is all part of Trump's Project 25 playbook. You know what else he's taken from Project 2025, Chair Powell? Their plan to eliminate the Fed. We're watching this play out as Trump doubles down on his efforts to gut the independence of the Fed. As we have seen with demands that you drop rates immediately. In fact, his co-president Musk attacked Fed independence in a tweet earlier this year. Chair Powell, I know you have been adamant about the independence of the Fed and have, thus far, resisted pressure from Trump. But after your decision to eliminate DEI initiatives following Trump's illegal order, I'm concerned that Trump has more influence over you than you let on. I speak for all of my colleagues on the Democratic side when I say that you must stand firm in defending the Fed's independence. Reject any attempt by Elon Musk and his Doge minions to gain access to the Fed, its systems and data, and speak forcefully about what's at stake for our economy. The American public must hear from you, our central bank, today.
Gentlewoman yields back. I yield myself 5 minutes for questions. Thank you again, Chairman Powell, for being with us. Let me start with the Fed's bank regulation and supervisory function. As I mentioned in my opening statement, over the past 2.5 years, the outgoing Vice Chair for Supervision has pushed new regulations that would move the United States towards a one-size-fits-all approach to prudential regulation that disregards the congressional mandate that's been quite clearly established for regulators to tailor bank regulation based on an institution's size, complexity, and risk profile. Earlier this year, the Fed board announced that Michael Barr would be stepping down from his position as vice chair on February 28th, 2025, or earlier, should a successor be confirmed. Significantly, the board also announced at that time that it does not intend to take up any major rulemakings until a vice chair for supervision successor is confirmed. I've discussed this with you. I've got concerns about that. You're not abdicating your supervisory response while we wait around for a vice chair for supervision. Do you agree that it's the Board of Governors that has the responsibility for bank supervision policy?
I do, and I would also agree that we need to carry on with our regulatory and supervisory duties. We can't take a holiday, and we will proceed with the things that we should be proceeding with.
You testified in the Senate yesterday, and know you enjoyed time with the senators, and you talked a little bit about Basel III endgame. And again, in my opening statement, I talked about that the intent was to harmonize those rules, true for the largest institutions in the world, but also do that in a way that's capital neutral. And many of us here in Congress on both sides of the aisle felt like Vice Chairman Barr's approach was gold plating already high standards for American banks. You testified yesterday that you think bank capital levels are about right for those large institutions. Would you tell the committee today that it's your intent to repropose a Basel III endgame approach, just speaking on behalf of the Fed only, not the other supervisors, and that it be take into account the comments and that it be generally capital neutral?
We do intend to repropose Basel III endgame, and we intend to do that just as soon as we can get together with the new leadership at the two other banking agencies. And as I mentioned, I think we can do that pretty promptly once those people are in place. I look forward to doing that. My long-held view, as I've said in many of these hearings, is that capital in the banking system for the largest banks is at about right. And that would be my starting point on going into these discussions. But I do want to defer. I do want to, leave it for my upcoming, new leadership at those agencies to have their own views on that.
I think that's important. I think it needs to be coordinated and harmonized among our supervisory agencies. And I do want you to take into account how Basel III endgame proposal interacts with other pending rules, whether they're on liquidity or the other things like operating risk in the companies. I think that was a lot of centrality of the comments that we saw on your Barr proposal. Turning to monetary policy, looking back at 2020 and 2021, I was looking at all the principal monetary policy rules that you report in your semi-annual report. And had you followed any of the monetary policy rules that you track, they would have had you tighten sooner in the cycle rather than waiting. And I think that could have reflected, maybe not seen us have a 40-year high in inflation. Using the benefit of hindsight, do you think you should have looked at those rules more closely in the open market operations and tightened sooner?
I will say, and I've said before, that hindsight suggests that it would have been good if we had tightened earlier. I don't know how much difference that would have made, but I'd be very careful with those rules. Those rules, those rules in the middle of last year suggested that our policy rate was a couple hundred basis points too high. You know, so we need to. They're a starting point, not an ending point. Is
right. But we've had this conversation before. The point is that they do offer a roadmap, and you do mention them in writing in your monetary policy reports, except for one time during the pandemic. And I think, though, that you're adding that to your reference point and your forward guidance and in your communications, I think would be important. Can you tell us about the review of the inflation targeting and when you expect to complete that?
Expect to complete it by the late in the summer this year. We're just beginning it now, and we're going to look at all the decisions that we made, why we made them back in 2020. We're going to ask ourselves what's changed. We're going to be open to criticism and good ways of thinking about it, and I think we'll make appropriate, discrete adjustments.
I thank you for being with us today, and I turn to the ranking member of the full committee, Mrs. Waters, for 5 minutes for your questions.
Thank you very much, Mr. Chairman. It is no secret that President Trump, that he wants to do away with the Federal Reserve altogether. He said he knows interest rates much better than you do. I want you to know that some of us here have been fighting to make sure that everybody understands the importance of the central bank. Every country dealing with crypto, their central bank is involved. But of course, Trump and the opposite side of the aisle fought us. And that's one of the reasons we were not able to come together with a bipartisan agreement on stablecoins. You previously said that you would not resign if Trump asked you to do that. Do you stand by that commitment?
I have no changes to that.
I can't hear you.
Yes.
Thank you. Please let the record record that adequately. I appreciate that because you have a right to your position not to be interfered with by law, I believe, or even Constitution. When Musk comes knocking at the Fed's door, you gonna let him in?
I don't have anything for you on that.
Would you like to tell us today that you won't let Doge into the Federal Reserve or have access to the systems and the data?
So I don't have any, we've had no contact, and I don't really have, I have nothing for you to report today on that.
Well, you know what happened at Treasury, and you know what happened over at the CFPB, and the people of this country are being violated because all of our privacy is being taken up by Elon Musk and Trump, and we don't know what all they have on us, our bank accounts, everything that in our lives. So I want to protect it in the Fed. Mr. Powell, the last time you testified before this committee, you said, and I quote, "Really successful institutions in the United States generally are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table. That is the way we feel about it. And at the Fed, and that is what we've been doing and will continue to do. Chair Powell, how will you ensure that the Fed continues to attract the best and most diverse employees?
We're institutions like ours, private and public, are in a constant contest to hire the best talent in the country. And we've all learned, I think, and certainly we have, that we will go anywhere to find that talent, and including places that we didn't go 25 years ago. And we'll just continue to do that. We're recruiting, as you know, at many, many, many universities and colleges, including historically Black universities and colleges, and others. And that's what we find, and that's our practice. We think that's the best way to go about it.
Thank you very much. And that's what I've always felt about the Fed. No matter what they call it, you only attracted and hired the best qualified people in your operation, no matter what they refer to it as, what they call it, whatever way they define it. Is that right?
Yes.
Thank you very much. Chair Powell, are you willing to provide my staff with an immediate briefing from your agency on the status of your OMWEs and equal employment offices?
Yes.
Thank you. I believe that you know that the OMWEs were created with the Dodd-Frank reforms. It's in law. And as I understand it, any attempt to dismantle OMWEs would have to come before the Congress of the United States of America. Is that your understanding?
Well, yes, Section 342 of Dodd-Frank, which is the OMWE section, is the law.
Thank you. Chair Powell, to what extent have you consulted with other board members in determining how your agency is complying with Section 342 of Dodd-Frank and as well as any other federal anti-discrimination law?
I think we've consulted with senior staff and board members quite a bit.
Chair Powell, days after his inauguration, President Trump issued an executive order on digital assets, which includes a prohibition on central bank digital currencies or CBDCs. The executive order banned any, quote, form of digital money or monetary value denominated in the national unit of account that is a direct liability of central bank, end quote. I'm concerned that this extremely broad definition could go far beyond CBDCs. Well, thank you very much. My time is up, but I appreciate your presence here today, and I appreciate your willingness to stand up for your right to be
Gentlewoman's
the
time
chair.
has expired.
And
But
I now yield back. Thank you.
But I do invite the chairman to respond to the gentlewoman's question on CBDCs in writing. And now we turn to the vice chair of the full committee, Bill Heisinger, the gentleman from Michigan.
Thank you, Mr. Chairman, and Chair Powell. Good to see you again. You had talked a little bit about your review. I'm going to start there. Obviously, a lot has changed in the last 5 years. Pandemic, inflation, higher interest rates, name a few. However, I believe your dual mandate of maximum employment and stable prices should remain the ultimate objective. I assume you agree with that. Let the record reflect slight head nod on that. This committee is going to be very focused on monetary policy, and with my good friend from Oklahoma, Mr. Lucas, chairing a task force that I'm happy to be a part of. We're going to be addressing some of those issues. Chair Hill touched on some of the rules that have been discussed. I, for one, have always been particular to Taylor rule, but there's a number of rules. I know you go through those. At one point, I suggested that we could call it the Yellen rule with Chair Yellen. But there needed to be some sort of public declaration of what to benchmark against, and I still feel that that is of some importance. You outlined your timeline on this particular review, but I'm curious. Do you believe that the last policy framework limited the Fed's response to raising inflation, something that you and I have talked about over the years?
No, I'll tell you why we didn't raise rates. We thought the inflation was transitory. I can show you forecasts from the end of 2021 by us, by staff, by the blue chip. Everybody thought it was going to be transitory. That's why we didn't raise rates.
And I also distinctly remember a hearing where you and Secretary Yellen at the time were sitting next to each other, and it looked like you visibly scooted away when I asked you both whether it was still transitory, and you had, for the first time ever, a separate answer. Her answer was yes, it still was transitory. You gave a very Fed speak answer of, we no longer believe the data shows that. So no. And to kind of go to Chair Hill's point, we think that might have been a little late on that. On back to the review, I'm curious, what sort of input are you looking for from the public and from Congress as you go into that review?
So from the public, we'll do a series of Fed Listens events, which were very successful the last time. And it involves us sitting down and meeting with people, some of whom know a lot about what the Fed does, some of whom just tell you what's going on in their communities. It was really, it was a very successful part of our outreach last time. In terms of Congress, you know, we'll keep you informed of our progress. We welcome anything you may offer. But it's a public. We're open to the public on this. It's a public review, as distinct from what we were doing before, and so we're welcoming views from all over.
And not to get ahead of the chairman, but I look forward to us having more conversations about that with the working group. I want to switch topics and focus a bit back to the bank supervision. Michael Barr has stepped down from his position as vice chair for supervision effective at the end of the month. And whether, frankly, President Trump fills that position is entirely up to him. But in the absence of a vice chair for supervision, you're still working, I think, on it. I think your quote to the chairman was, "There's no time for a holiday." Now, this vice chair of supervision is a Fed governor that has, frankly, extraordinary powers and responsibilities. And ultimately, my question to you is, does the Fed really need a separate vice chair to complete its work? Now, I got here after the 2010 election, 2011, shortly after Dodd-Frank was passed. I know this vice chair position was created by Dodd-Frank. I've just been dealing with the echo effects now for the last going on 15 years of Dodd-Frank. Do we really need to have a separate vice chair of supervision?
So for many years, as you know, we did our business without a vice chair for supervision. What that means is everything goes through the full board.
And it was effective?
I think it was, and also there was less volatility.
Explain that. Why was there less volatility?
Well, because you've got a group of 7 people on the board, and there will be some as appointments change. There'll be some changes in the approach to regulation, but putting it all in a single person, admittedly just to recommend to the board, can lead to sort of some volatility in these things, which is really
larger swings in policy.
Larger swings in the kind of things, and that's not great for the institutions that we want to regulate. We want to have a good set of regulation that doesn't swing back and forth very much. The question of whether it's a good thing to have in the law is really one for you. But I will tell you, we will once Vice Chair Barr completes his term in a few weeks, we will continue on until there's a new Vice Chair for supervision, and we can very much get our work done.
Or if there is one. So with that, Mr. Chairman, my time has expired.
I thank the Vice Chairman. Mr. Heisger yields back. Recognize the gentleman from California, Mr. Sherman, 4 or 5 minutes of questions.
Chairman Powell, you are the only bipartisan person or thing left in Washington. You were appointed by Obama. Trump gave you a promotion. Biden reappointed you. And you are the only Biden appointee not to hear the words, "You're fired," from our president. So I hope we listen to what you have to say, because you're the only person or that I can identify in Washington that has support on both sides of the aisle. Mr. Huizenga mentions the importance of your dual mandate. Project 2025 calls for abolishing the dual mandate and eliminating a mandate that you focus on employment. If we were to give you just one mandate dealing with price stability and take away the mandate on employment, over the next 10 years, would our GDP be higher or lower?
It wouldn't be possible for me to say.
Does the fact that you focus on employment as one of your dual mandates lead to lower unemployment, higher employment in our country?
It may do so. We do balance those things.
Thank you.
To some extent, that may be right.
Chair Hill spoke about how important it is that you maintain your independence. I noticed that in light of the hiring freeze, the Fed has removed all its job postings. I'm hoping that your personnel policy will be as independent as everything else at the Fed. But I'm more concerned with the president's statement at 7:58 this morning, where he said interest rates should be lowered. He said it. Will that influence what the Fed actually does?
I, as a practice, never comment on anything the president says, but I think people can be confident that we'll continue to keep our heads down, do our work, make our decisions based on what's happening in the economy, the outlook,
And
the balance of
statements
risks.
by elected
No
officials
change.
are not among the things that cause you to act one way or the other.
That's correct.
Thank you. And he went on to say, he said interest rates should be lowered, something which would go hand in hand with upcoming tariffs let's rock and roll America. I certainly agree with the rock and roll America, but the Peterson Institute says that the policies that the president ran on will raise the CPI by between 4 and 7.5 points. And I think the biggest element of that is the proposed tariffs. If we have higher tariffs across the board, say 10 to 25%, would that increase the cost of living? And would an increase in the CPI or related indexes of the cost of living lead to higher interest rates?
You know, there are many organizations, public and private, whose role is to speculate publicly about what this might be. What we're doing is we're reserving judgment until we actually know what the policies are.
But if we have a higher cost of living, does that lead to higher interest rates? The CPI goes up, or CPE, excuse me.
Well, if inflation goes up in general,
yeah,
forget about tariffs. In general, of course, we will use our tools, which is the interest rate, to bring it back down to 2% over time.
Okay. Yesterday, you told the Senate we're going to release the stress test scenarios before we implement them. Will you take a holistic look at large bank capital requirements, including the risk-based capital ratios like Basel III Endgame stress testing, to make sure that you don't have a contraction in the ability of credit to Main Street businesses?
Yes.
Great. There's a proposal in Project 2025 that we abolish Fannie and Freddie. If there was no explicit or implicit federal guarantee for those who invest in mortgages, would that lead to higher mortgage interest rates?
Since you'd no longer be borrowing on the credit of the United States, in other words, so Fannie and Freddie would be privately funded, it could lead to that. I think privatizing Freddie and Fannie might have other virtues too, though, as has been considered many times by this committee and others.
Might have some virtues, but it would lead to higher mortgage rates.
It could.
The CFPB has been put on ice, but all the regulations remain in force. So if you're a bank that wants to comply with those regulations, there's nobody that can give you any clarification. So you don't know. And if you're a bank that doesn't want to comply, the next presidential election may put into practice a CFPB that enforces all the regulations that the Trump administration has tried to eliminate. Does that cause confusion for banks?
You're speculating about what the situation might be. I would say that it could. Yeah.
I yield back.
Gentleman yields back. I now recognize myself for 5 minutes. Chair Powell, let's talk about the balance sheet. As we've discussed several times before, the consistent and massive growth of the federal debt creates long-run challenges for both the United States and saddles future generations with an onerous burden. But it also creates a challenging environment for the markets as the Treasury market expands in kind. As the Fed engages in quantitative tightening, allowing the Treasuries to roll off, the Fed is careful to ensure that there are ample reserves for the balance sheet. Could you briefly discuss the conditions that determine the ideal level of reserves?
Sure. So let me say that we intend to slow, and we have slowed, but then stop the process of shrinking our balance sheet at a time when we think that reserves are somewhat above the level that we judge to be consistent with our ample reserves framework. So what that means is we want reserves to be ample, meaning we don't want them to suddenly appear to be shortages of reserves. So we're going to think of where those shortages might appear, and we're going to put a buffer on top of that, because nothing good happens when there's not enough liquidity. So that's our overall framework. And right now we feel like all the evidence suggests that reserves are still abundant, which is more than ample.
As you know, in early 2021, the Fed stated that it would invite comments on the supplemental leverage ratio. That has not happened yet. I've made the point that the growth of the U.S. Treasury market paired with a decreased willingness of banks to act as intermediaries is a major issue on the horizon. When former Treasury Secretary Yellen was before this committee last year, I asked her about the resiliency of the Treasury market, specifically about the wisdom of permanently modifying the SLR. She said it's something that the banking regulator should consider. Does the Fed plan to finally look at the SLR?
Yes, I believe we will. I have, for a long time, like others, been somewhat concerned about the levels of liquidity in the treasury market. The amount of treasuries has grown much faster than the intermediation capacity has grown. And one obvious thing to do is to reduce the effective supplemental leverage ratio, the bindingness of it. So that's something I do expect we will return to and work on with our new colleagues at the other agencies and get done.
Because I think my colleagues are aware that over the course of recent times, literally we have 8 times as much debt to process, but only half as many major market makers. The Federal Reserve is not immune to politics. You, like every Fed governor, go through a lengthy confirmation process in the Senate. And of course, you're required to answer to Congress in hearings like this. I can trace a major political turning point at the Fed to the passage of Dodd-Frank, which greatly expanded the Fed's regulation and supervision authority. Chairman Powell, do you worry that the independence of the Federal Reserve's monetary policy function is in any way hindered by its role as a bank regulator? Can you do both?
Well, we can and we do, and we'll continue to do that. Clearly, the regulatory and supervisory side is more contentious in political circles, but we will continue to carry it out as best we can and to do so in a non-political way as best we can.
And clearly that'll be a major discussion topic in the task force. In my remaining time, could you discuss the Fed's 5-year review of monetary policy? What are the categories of issues you think that will be helpful to receive feedback on?
So a good part of it will be looking at the changes we made in 2020, which were made in an environment where we had been stuck at the effective lower bound at 0 for 7 years. And the highest we got our rate really was sustainably was 1.5%. And that was the highest of any advanced economy central bank. So the concern was that at the slightest downturn, we'd be back at the 0 lower bound and we'd be stuck. So we were looking for ways to make up for that. So then the question is, we got this inflation out of the pandemic and the events related to it. Are we in a different place now? And I think the chances are pretty good that maybe the effective lower bound is still a concern, but it's not the base case anymore. So we need to look at that and decide how what are the implications of that for our framework.
Thank you, Chairman, and I look forward to several more discussions on these topics. And with that, I yield back the balance of my time, and I recognize the gentleman from New York, Mr. Meeks, for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, thank you for being here today. And you've indicated in past hearings that geopolitical tensions pose important risks to global economic activity. Back around this time last year when you appeared before the committee, you and I discussed how conflicts around the world, specifically the war in Ukraine, had impacted the cost of things like groceries in the United States of America. At that time, you indicated that the war had caused commodity prices to move sharply back home. Does that sound correct to you, if I'm familiar to you?
Yes, it does.
So just to reiterate, in this interconnected world that we live in, would it be safe to say that economic instability in other countries has the potential to impact economic factors here in the United States?
Sometimes, yes.
And so, given that fact, would it seem like a smart move for the United States government to remove one of our most effective strategic tools that, by mandate, assist U.S. commercial interests by supporting developing countries' economic growth and building countries' capacity to participate in the world trade? Would you agree with that?
It's not for me to be the judge or to say on that.
Well, we do know that a number of, like USAID, they buy a lot of their agricultural products, etc., from American farmers. And in fact, it helps the U.S. economy when you look at the volume of agricultural products that are being bought so that we can continue to be a part of the rest of the world. Would that be correct?
As far as I know, yes.
So, today we find ourselves facing a situation where the president and his Dodge buddy Elon Musk seem hell-bent on dismantling USAID, no matter the consequences, even if they are dire. To me, the assault on this congressionally authorized body represents an attack on the rule of law and should outrage every member of this body. Every member, Democrats and Republicans alike. And I know that your interest is squarely within your dual mandate and not foreign policy. I sit on both committees. I'm here, but I'm also the ranking member on the Foreign Policy Committee. And so I can't sit here today and pretend that what we're doing won't impact employment and economic stability right here in the United States of America. Weakening USAID will fuel global crises, endanger American security, embolden other nations like China and Russia, and leave us here in the Trump administration solely responsible for the fallout. So I have to take this opportunity to urge my colleagues on the other side of the aisle to also stand up for USAID. Anytime we travel, we go visit what they do. We go visit the good that they do. We go visit what and how their economies improve so that they can be part of the global economy. So, if not because people just care about the rest of the world, then because we care about our country and recognize that instability elsewhere threatens our stability right here. It is extremely important in an interconnected world because the economy is interconnected around the world. We cannot isolate ourselves from the rest of the world. I thank you, Mr. Chairman, and I yield back the balance of my time.
Gentleman yields back. The chair recognizes the gentleman from Texas, Mr. Sessions, for 5 minutes.
Mr. Chairman, thank you very much. Chairman Powell, welcome. We're delighted to be here, and I hope that this comes with greetings from every single member that we appreciate and respect you taking the time, even though you're expected here. We think you show up, and we admire you. Mr. Chairman, you and I both know that way back when, and we assume 21, that there was a decision made by the Fed that gets close to quantitative easing and then the term tapering. And we know that it was sold as a monetary stimulus to help the country, and I get that. There was about, in my opinion, $2.33 trillion that were taken out in loans. And Chairman just spoke a minute ago about the term debt versus growth. Debt versus growth, about this amount of money that sits out there on the debt side. Could you please take a minute and discuss this issue and how we should be looking at it? Thank you.
Sorry, Mr. Sessions, are we talking about asset purchases that we made during the?
We are. We're
Okay.
talking about when the Fed went and sold
QE.
treasuries.
No, we bought treasuries.
Bought treasuries.
Yeah, we bought treasuries. So, it was a situation, I'll tell you why we did it. We were just out of the worst part of the pandemic, and we didn't know frankly, how good things were going to be, how strong the economy. We were very concerned. COVID is still raging, and it actually, had a very strong wave right into 22. But we wanted to we didn't want to stop buying treasuries too soon, because that has a stimulative effect on the economy, because we didn't want to provoke an unwanted tightening in financial conditions at a time when we thought the economy was still vulnerable. You look back in hindsight, we probably could have done that earlier and halted purchase earlier. In any case, we turned right around and started shrinking the balance sheet, and we've gotten.
You moved it from about 120 a month to 110.
But we're down now. We've been tapering for 2 years now, and we're down
That's
more
correct.
than $2 trillion. So, and we're still going. So that's why we did what we did.
Tell me what that looks like in the longer term aggregate versus with what the chairman said, debt versus growth. Because we believe the debt remains and the growth is not equaling that ability to pay it back.
So what happens is we borrow money to cover the spending that Congress has done. Our purchases don't affect that. We're basically issuing reserves, which is cash, and we're retiring Treasury securities. And the effect of that is to drive down long-term rates. That's the whole reason for QE.
And what are you paying for those long-term rates?
Market rates. We're paying exactly the market.
And what would that market be approximately a year ago or to now?
Well, the 10-year, we're not, of course, we're going in the other direction now. We're shrinking now, but
We
we're
are.
buying, the 10-year was yielding a very, very low yield, and it was quite low during the pandemic, extremely low because, growth was slow. There was a lot of demand for treasuries. So we were pushing down rates to support economic activity. That's when you can't lower your policy rate anymore and you want to do more stimulus, that's really the main thing you can do. It's actually the forefather of that was Milton Friedman, who came up with that thought way back in the past. But that's what we did. And then, as I mentioned, we turned around as soon as we lifted off and started raising rates. We immediately started shrinking the balance sheet, and we've shrunk it a lot, $2 trillion and still counting.
You have shrunk it $2 trillion?
Yes, we have.
Okay. And what do you believe remains, and you believe you're now stable for moving forward?
So I think we have a ways to go. Actually, the level of reserves, which is the thing we're focused on, hasn't really changed. All of that has come out of what's called the overnight reverse repo facility. I'd be happy to spend some time with you on this. This stuff is very complicated. And
yes, I've tried to find new data on it, and the last I found really was a CRS report of 22. So
it's
what's
very,
called
very big changes since then.
127, 22. And
Yeah.
so the changes that you speak of are important.
Yeah.
And so I would appreciate that time.
Be happy to do
because
that.
Great. I want to thank you for being here. The confidence that the American people have that we will turn not just the economics of their lives, but of the country is very important. And I today spoke about the country. And I want to thank you for your service and time. Mr. Chairman, I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much, Chairman, and welcome, Chair Powell. Chair Powell, I'm worried about these tariffs, and I want you to kind of share with us your thoughts on these tariffs. I'm worried about it. I think the president is wrong here. Tariffs can cause a terrible situation to the economy. I'm concerned about the inflationary impact on tariffs. And where cost increases from the tariffs, there's a cost to these tariffs. And we need not move into this area blindly. And some of these costs will be absorbed by business companies, but there are other costs that will be borne by the American consumers. We don't even understand this. And yet you have the president just using these tariffs as a means of fight or like a war. And this is going to do it. Everybody is not going to be Mexico or Canada. And while we got a little time, I want your thoughts on the dangers of these tariffs. The stock market is anticipating rate cuts. What will these tariffs do about that? Does the Fed see financial market stability as a factor in its decision-making process when considering the rate cuts? And here is specifically what I want you to get to. In light of the president, and politely I will say, his ill-crafted tariff strategy, do you foresee future rate cuts as a result of inflationary issues or due to a weaker labor market? And what do you consider to be promising inflation data? That's our big fight. And these tariffs are going to just add to inflation like a rocket ship. Your thoughts?
So,
and share with us. Give us your opinion of the danger of these. There's a cost here. Tell us what you think about this.
The president has certain authorities over tariffs. Congress has authorities over tariffs. The Commerce Department is involved in some ways, but the Fed has no role in setting tariffs. And we don't comment on decisions made by those who do have that authority. We try to stick to our own knitting. In this particular case, it's possible that the economy would evolve in ways that, because of tariffs or partly because of tariffs, that we would need to do something with our policy rate, but we can't know what that is until we actually know what policies are enacted. And remember, it's not just tariffs. There are significant changes to immigration policy, fiscal policy, and also regulatory policy. You put all four of those, and all four of those were things that the president was elected to do. We will then try to make an intelligent judgment about the overall effect on the economy of those, and conduct our policy accordingly. But it's not our role in any way to comment on the wisdom of the policies that are enacted by Congress or by the administration.
Will he have an effect on whether or not you will resume your plan to cut the interest rates this year or continue to hold?
So we'll make our decisions as we go about what to do with interest rates based on the data that we see, the outlook, the evolving outlook, and the balance of risks. And we'll be considering all of those things. We won't be focusing on any particular policy, and I can't tell you what we'll be doing, because it will really depend. It's fairly uncertain environment right now.
Yeah.
The underlying economy is very strong, but there's some uncertainty out there about new policies. We're just going to have to wait and see what the effects of those policies are before we think about what we can do.
Well, all I want to say, God bless you. I know your strength. We've worked together over the years on many things, and this nation is grateful that we have you, your wisdom and intellect at this time.
I agree,
So
but the
that-
gentleman's time has expired. Gentleman, you're back. Chair now recognize.
All right, guys, that's all I got. I'd cap out at about an hour of that stuff. Overall, always interesting to see if they ever ask Powell a question that really gets him to leak anything interesting. Nothing really too substantial there. The thing that always triggers me about these types of testimonials are when Powell testifies to Capitol Hill is it feels like it's like 10% actually communicating with Powell and like 90% of like pushing that person's political perspective. Again, that's what those guys do all day long. But it's almost like they bring Powell on as like a secondary reason to just talk about why they want rate cuts, and I don't know. Anyways, definitely do agree with pretty bipartisan. You can see they like having Powell there. I do think it is in the best interest of government to keep the Fed kind of a third party bipartisan thing. But we'll see. I mean, overall, market's reaction here today to higher inflation is not particularly bright, although pretty resilient. You got the stock market bouncing back a little bit. Here's the NASDAQ. At one point, NASDAQ was down somewhere around 1.3%. We've bounced back about down 0.5% here today. Russell taking it harder than the other indices if you're talking stocks. Gold, my goodness, like this is what I was saying earlier, just the resiliency of gold price right now, despite higher inflation, gold still bouncing back. And again, I think that that goes back to what we actually discussed before the CPI report. I'm not just saying this with hindsight. We discussed this exact concept where basically I mentioned earlier that if you get a hot CPI print, I wouldn't be shocked if gold bounces back. And that's exactly what happened. I'm not always correct or right about what's going to happen in the markets, but this morning we did discuss that theory simply because of this. Look at what we're looking at, guys. Here's your economic heat map. Do you see how much red is on the screen right now? What is that telling you? That's telling you that most of our economic data points are signaling quite literally some red flags here. You've got a lot of growth metrics coming in lighter than expected, retail sales, services PMIs, growth. And now today, inflation hot. Core CPI month over month jumped up. CPI year over year jumped up to 3%. That's up from previous and up from forecast, up 0.1%. So you had some hot inflation reads. And the market is not going to love that, right? Inflation going up is not something that market participants wanted to see this year. They wanted to see rate cuts this year, and it's going to be really hard to forecast rate cuts unless you get inflation cooling off, which we didn't get today, or the other side of the dual mandate from the Fed, cooling jobs data. And we're not really seeing too much of that either. So rate cuts right now seem to be put on hold. And that is why, of course, when we take a look at our stuff here, when we take a look at, TLT, for example, right? TLT is selling off today because you have higher than expected inflation, which is causing the 10-year yield to jump. So be cautious with that. I mean, that does impact a lot of things, but the resiliency here of gold and silver is very impressive. I am still long silver. Stop loss hasn't been moved, but if we do continue to push higher, I'm going to probably look to just trim my stop loss on that front. So with that said, guys, we're going to probably shut down the stream. If you do want to try out the Edge Finder, we'll drop a link to try it out here in the chat right now. If that's something that you're interested in, if you'd like to try the tool, the heat map data for economic stuff. Of course, we also have sentiment data like the commitment of traders data, retail positioning, put to call ratio, investor sentiment surveys, the smart money indicator. We got a million tools here for basically improving the insights behind your trading. If you don't already have a copy of the Edge Finder and you would like to try it out, click this link that's been dropped in the chat by our support team or our stream team here, and you can take advantage of that 30-day trial or get some information about it. With that said, guys, thank you very much for tuning into the live stream. Have a great rest of your day, and we'll see you back tomorrow.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.